Okay, we'll be looking at the areas of budget and budgetary control, the various types of budget that you can prepare, and the various types of budget that they will be asking you should prepare in the exam. Okay, so I've made it that, okay, we can see all the types of budget in one question or maybe in two questions. So we come to standard costing also. We'll also look at the issues on the standard costing, how to calculate the basic standards, and the basic variances, and how to calculate the advanced variances also, and sometimes how you can prepare, or you should prepare a reconciliation statement. So we try our best to see whether we can solve two questions on each of them and see what will happen in the next 3 and something hours. Okay, so yes, let's start with let me just give an overview of what you will be expected to do under budgeting, okay, or under budget. Okay, so budget is just a format or a statement showing the income and expenditure of an organization together with what the resources that we are going to be using to generate such income. So you'll be seeing revenue and expenditure for a particular period, or is a statement that is showing the target or the production target of an entity. Budget is just like a target. You are setting a target against which actual performance will be benchmarked. So they can ask you about the benefits of budgets, or they can ask you about the various technologies in budgeting, like the budget manual, the budget period, budget committee, budget Slack. They can ask you about those things, so you should be able to explain those issues. They can also ask you about the types of budgets and also the approaches that we use in preparing budgets. Okay, so they can ask you to differentiate between flexible budget and a fixed budget. Flexible budget is a budget that takes into consideration the actual result. So what will happen is that you are preparing a budget that the budget will be changing with the output level or with the level of activity. So if you take 2 people to the farm and you are paying them 200 cedis, if you now take 3 people to the farm, you should be paying them 300 cedis. You should not be saying that you are still going to be paying the 3 people 200 cedis. No. If you are doing this, it means that you are having what we call a fixed budget, a budget that is just static, no matter how the output level or the activity level, it is still the same. But situation where you now adjust your budget to reflect the actual performance, we say that is a flexible budget. So they can ask you to prepare a flexible budget. Okay. They can also ask you to prepare a cash budget. It's just like how you prepare your cash book. Only the cash items will come in as receipts, and only the cash items that will be going out as payments. Okay, the problem is always about the collection and the payment schedule. How do we collect the money from our customers? How do we settle our suppliers? That is always the problem about the cash budget. They can also ask you to prepare functional budget. You should prepare budget for each functions. Mostly it's going to be the sales division or the sales department. They are going to be preparing sales budgets. Then you cannot sell without producing. So the production department, they're also going to be preparing a production budget. What is their target in terms of production? They have to produce for the sales department to sell. Okay, we can't produce without buying raw materials. So we have to have the raw material usage budget and the raw material purchases budget. What is the raw material, the quantity of raw material that we are going to be using to produce? And what is the quantity of raw materials that we should be purchasing? There are 2 different issues. Okay, then you can also talk about issues of labor budget. You can also know produce without engaging the workers. So how much are you going to be paying them? What will be the number of hours that you'll be using to produce? Those are that's how the labor budget will be prepared. Okay, then I've spoken about cash budget already. They can also ask you questions on some theory side. Mostly it can be based on zero-based budgeting, because that is the modern way of budgeting, or the modern approach to budgeting. Zero-based budgeting. Zero-based budgeting. It's It prevents issues of budget slack. You cannot just stand up and be including items for your own benefits. No. Any item that you say should be included, you have to come and justify why you are saying that that particular item should be what included. So they can ask you questions on the zero-based budgeting, the stages involved, maybe advantages or disadvantages. They can also ask you about incremental, rolling budgets, participative budgets, top-down budget approach, or bottom-up budget up. They can ask you about all these theory issues. So you should be able to be okay with them. But we are going to be looking at some portion of the calculation and also some portion of the theory. So our focus will be on all the three major areas. Although last sitting was functional budget, they can still bring the functional budget. So we need to have a knowledge about it. Flexible budget is likely if they want to examine you on calculations. Cash budget is also likely, and the functional budget is still what? Likely. So we'll be looking at how do we calculate issues about these three types of budget or types of budget that you'll be asked to prepare. Okay, so we are going to be taking question 1 and question 2, then we move on to standard costing now. Standard costing and budgeting they are the same. Okay, they are almost the same. But for budgeting, we calculate the variances on total basis. But for standard costing, we try to break down what the variances into a component that will be very easy for us for decision making. Question number 1. Who is helping us with the question number 1?
Okay. Can I read?
Yes, now.
Okay. Dela Limited has recently opened a fast food restaurant in a small town. Fast food restaurants are characterized by their quick food service. The fast food restaurant market in the town is dominated by a small number of long-established restaurants. Dela Limited is seeking to grow its business and attract the town's residents with its burger meals. The performance report for the first month of business is to be presented at the restaurant's monthly management meeting. A draft of the performance report for the first month of business is reproduced below. So we have sales, a number of meals, we have revenue, variable costs, fixed cost, profit. The management accountant at APZ has realized that the size of the fast food market that was used to drive the budget number of meals to be sold has been overestimated. The management accountant has calculated the value of the sales volume contribution planning variance to be 2,480 adverse. Required. Prepare a revised budget based on the new estimate of the market. B. Prepare a performance report for the month based on flexed budget. C. Explain 2 non-financial measures that APZ could use to monitor the performance of the new fast food restaurant.
Okay.
I'm done.
All right, now I'm coming. So the first one is that we should prepare a revised budget on the new estimate of the market. We should prepare a revised budget. Okay. What was our budget for the period? What was the unit, the meals, the number of meals that was budgeted for? What was the number?
The question again. Which one?
Yeah, I'm saying that what was the number of meals that has been budgeted for?
6,000.
Okay, 6,000. Yeah, the last time we said that in every organization we have three levels, isn't it? We have the strategic level, we have the tactical level, and we have the operational level, isn't it? Okay, so the people at the strategic level, which we call the top management, they are going to be setting what? Setting targets, and this target will be given to people that we call the middle level people. Okay, so the middle level management, will now look at it and now give it to what? They will now communicate to the lower level people, which we call the operational managers or operational level. Okay, so these people, they don't have any idea about a production process. So they are going to be given what they think is what is right. So they will make a provision, or they will make what? An estimate. The estimate will be given to these people. These people are dealing directly with these people, so they know how production process will go on. So they will now look at the budget given by the top management. Then they will now look at it, looking at the resources available. Then they will now revise it over here. Okay, so if we are saying that we are having 2,000, we are going to be producing 2,000 units, and this is what they are saying that, okay, the actual units or the units that should be budgeted for based on the resources that we have will be 1,800. So then it means that there is be a difference of 200 over here. So the difference, the variance happening over here at this level, the top and the middle level, the difference that they are having in their budget is what we call the planning variance. So the planning variance. So the difference that they are having over there is what we call the planning variance. Okay, let's pay attention to this. It's a very simple question, but you need to be very very critical to be able to resolve issues around that. Okay, all right. So this 6,000 over here, this 6,000, okay, that particular 6,000 over there is for budget at the top level. Okay, the budget has now been given to the middle level people, and they have now revised the budget. After revising the budget, they have calculated that, okay, their sales volume contribution planning variance will be what? 2480. The question is, how do we calculate sales volume contribution variance? How do we calculate sales volume contribution variance? How do we calculate sales volume contribution
Actual
variance?
quantity management.
Okay, sales contribution, sales volume contribution variance. Okay, contribution will be based on the unit that we are selling. So we are basing our contribution on 6,000. But what is the amount that the the tactical level people are now saying? So we have the budgeted quantity. Okay, the budgeted quantity minus the actual quantity multiplied by the standard contribution per unit. So you have your budgeted quantity. Contribution is always based on units. Okay, we are basing our contribution. Our revenue has been calculated based on the budgeted units. But what is the actual units? So what will be the difference in our contribution? That's what we call the budgeted contribution. And that is going to be the budgeted quantity minus the actual quantity. Okay, this is at the planning level. Okay, this is at the planning level. This is at the planning level. So at the planning level, the budget by the top management is what we call the budget. Okay, the top management target is the budget. But if you come to the middle level before the budget will be communicated to those at the operational level, they will now revise. Their revise will now be the actual for the planning variance. So the revise over here is the actual. Okay, they are saying that they have calculated the sales volume contribution variance. This is planning. It will be between the top and then the middle. Okay, the top is giving us a budget of 6,000. So what will be the amount for the middle? The middle one is the revised amount, and that's what we are asking us to find. Okay, so our sales volume contribution is what? Is 2480. And the question is saying that it is adverse. Adverse means what? Is it going to be negative or positive? Adverse.
Negative.
Okay. So you have your negative. Okay. So you have your negative 240 is equal to our budgeted quantity is what?
6,000.
6,000. Do we know our revised amount, which is the actual for the middle level people? Do we know that?
No.
Okay, so you just leave it like that. You have to find your revised amount before you can do that particular budget. Multiply by the standard contribution. Can we find the standard contribution? Someone should help us find the standard contribution per unit. Standard contribution per unit. How do we find contribution first? What would be the?
So is it 3.1?
I have to confirm that. Okay, let me check. Okay, the standard contribution is just the budgeted contribution per unit. So what is the contribution over there? 45,000 minus 26,400 divided by 6,000. Okay, I'm getting 3.1. Okay, so let's show how we calculate that. Okay, so our budgeted contribution, let me show workings here, somewhere here for the budgeted contribution. It's a very interesting question, but just that you have to think deep. So let's come to our standard contribution per unit. Okay, that will be our budgeted sales. So our budgeted sales will be 45,000, and our budgeted variable cost will be how much?
26,400.
26,400. Okay, what will be our contribution?
18,600.
Okay, you see, the 18,600 is what we call the budget. So whenever you are doing the thing at the total level, budget is always at the total level. But if you break it down per unit, that is what we call the standard. So what you have to do now is that you have to now look at your demand over here, which is the unit that you are selling. That will give us 6,000. So you divide by 6,000. So the 18,600 is the budgeted. But if you try to find the value per unit, that is what we call the standard. So standard is always at the unit level, while the budget is always at the total level. So they can give you budgeted figures. As soon as you find the amount per unit, that is a standard. Standard is calculated at the unit level. All right. So we are having 3.1 as there was the standard contribution per unit. So let's multiply this. We are just going to be doing some small mathematics over here. All right. So we have negative 240, 2480 is equal to, can I have 6,000 multiplied by 3.1?
18,600.
Okay, minus what? 3.1 multiplied by the revised quantity. Can we have something like that?
Yeah.
Okay, so we have negative 400 is equal to 18 what? 600.
600.
Okay, minus what? 3.1
3.1
AQ.
AQ.
So can we group items?
Yeah.
18,600 is equal to,
So minus.
okay, this will also be minus. Also, thank you.
Mm.
Okay, so that will be minus this one. So we have 3.1 AQ.
The 3.1 will also be minus.
Okay,
So let's turn to that.
let me do it like this. Let me just change it. So 3.1 AQ is equal to 2480 plus 1,000.
Plus, yeah.
Okay, so that the negative and negative will not be worrying us again. So
3.1 AQ is equal to 2180. 21080, sorry.
this let's come here. The contribution is adverse. Okay, if it is adverse, we cannot have this cannot be negative if it is adverse. Okay, this is revenue. So if revenue is adverse, budgeted quantity minus actual quantity. So contribution, if that is adverse, if it is adverse, it's supposed not, the figure is supposed not to be higher than the, it cannot be adverse and our revised amount will be more than the budgeted. Okay, so this supposed not to be, this supposed not to be negative, supposed to be positive. So if cost is higher, if cost is higher is positive. If this one is adverse, if revenue is adverse, it's supposed to be positive. Okay, if cost is adverse, negative. It cannot be I'm getting 6,800. Okay, that cannot be 6,800 because it's adverse. It cannot be higher than that. Okay, so adverse contribution as is adverse, that should be, okay. If contribution is adverse, means that the actual quantity should be lower than the budgeted quantity. Okay, so let's come here. Let's get a trick here.
Hello, Senior.
Yes, please.
Hello, Senior.
Yeah, Senior, I can hear you.
But we know that the difference when we have adverse as a result, sometimes it's not always from the volume alone. Maybe the price too, or in this circumstance, because it is very specific as sales volume.
Look at this one. Look at this. Let's come here. We are having, it is adverse. Okay. If it is adverse, it means that the budget, this is sales. So if it is adverse, it means that our budgeted is higher than our actual, isn't it? Okay. But what we are going to be doing is that we are going to be, okay, let's say that is adverse. So we have 6,000. You want to sell 6,000. You are now selling, let's say, 5,800. This will be adverse, isn't it?
Yes.
Okay. If you want to calculate the figure to be adverse, this is how you are going to be doing it. It's supposed to be 5,800 minus 6,000 so that you can get negative 200. Is that correct? Is this correct?
Yes.
Okay. But if you are now doing 6,000 minus 5,800, what will be the figure that you'll be getting? It will be positive.
Yes, you are correct.
This will be positive, isn't it?
Yes, it will be positive.
Okay. What are we doing over
Yes.
here? This is 6,000. The budgeted have to be higher than the actual. So if you are doing 6,000 minus the actual, the figure over here will be positive. So we need to keep this one as positive. Okay. Unless you change it to be actual minus the budgeted, then you can add a negative here. You always have to. But whatever be the case, if it is, we don't have a format of doing this. Okay. Most of the time, people have been telling us that if cost is adverse, then it means that it will be negative. If cost is adverse, it will be negative. Okay. If revenue is adverse, it will be positive, depending on how we are calculating it. Okay. We are calculating budgeted minus what? Minus actual. This case, budgeted should be higher than the actual. The figure that we have over here should be positive because we are subtracting the lower figure from the higher figure. But if you are subtracting the higher figure from the lower figure, then you'll be having the negative attached to this. So this should not be negative. Thank you. All right. All right. So let's have, this should not be negative. We need to have negative 2. Okay. We need to have negative 2480 plus the 18,600. Okay. So we have 3.18Q is equal to, what are we having? I'm having 16,120.
16,120.
Okay, divided by
AQ is equal to 5200.
Okay, so we need to have 5,000 mils. Okay, this is how it's supposed to be. What it's supposed to be? It's supposed to be adverse. The adverse is supposed to be lower than the budgeted. Okay, so the negative that we added first one, it's based on the assumption that we are subtracting the higher figure from the what the lower one, which is not the case. Okay, let's look at this. 6,000 minus 5,200. Okay, multiply by 3.1. What figure are you going to be having? You'll be having positive 2480. It will be positive 2480, isn't it?
Yeah, 2480 positive.
Okay. So you have to define this by adding A to be adverse. If you don't add the A, this is a positive figure because this is 6,000 minus 5,200. We are going to be having 800 as a positive figure multiplied by 3.1. That will give us a positive 2480. But if you're having 5,200 minus 6,000, okay, multiplied by this one, okay, you don't have to add adverse to this figure again because this is already going to be giving negative. So 5,200 minus 6,000 give us negative 8,000, negative 800 multiplied by 3.1. You'll be getting negative already. So I hope you are now getting why negative should not be added to the negative to the 240. Okay. All right. Thank you. So supposed not to be negative. So our revised budget is 5,200. Our revised estimate is 5,200. They are asking us prepare. Yeah, Sina Mohammed.
Sorry to take us back a bit. I understand how we had a 2480 in the question.
Yeah.
I mean, in calculating the sales volume contribution, which we are given, and we're not to find the actual quantity. I thought in the actual quantity.
We are to calculate the revised what quantity. We are calculating this at the planning level. So revised at the planning level is the actual for the planning variance.
Okay. So that means that the actual quantity that we have in the question is not the actual quantity.
It's operational level. If you are calculating operational variance can be calculated into two categories. We have the planning level and the operational level. But what we have been doing is that you have been combining the two. So you just calculate the variance for all the two. Okay, let's check here. Let's calculate the contribution variance over here. Sales volume contribution variance. Okay, that will be sales volume contribution variance. That will be equal to 6,000 minus 5,400. Is that correct?
Yes.
Multiply by 3.1. Okay. This is if you are not asked to calculate on planning and operational. This is what you are going to be having. What will be the answer?
Why 1860?
Okay. So that will be 1860 adverse, isn't it? Okay.
Yes.
Okay. But what did we do? We are calculating this at two levels. So what is the sales volume variance at the planning level? The planning level is these people, they are estimating 6,000, but the people at the middle level are now giving us 5,200 as the budget. Okay, so we will now come and sell 5,400. So between the middle level and the operational level, that is also another level of what? Of calculating a variance, which is what we call the operational level. Okay, so the first one we have 2480, that is a planning variance. Let's come to operational sales volume contribution. So we have operational sales volume contribution. Okay, this will be between the estimate of 5,400, which is a revised amount. Okay, 5,200 rather. 5,200, which is the revised amount given to the operational level. But they have sold what? 5,400. Okay, this will still be multiplied by the standard contribution. How much are you getting here?
$260.
So,
620.
okay, 620 favorable, isn't it?
Yeah.
Okay, but at the planning level, what did we have? We have negative, isn't it? Okay. So our total contribution variance will now be calculated like this. Okay. Total contribution variance will now be the one at the planning level, which is negative 2480 plus 620. What are you having? You should be having the 1860 was.
Adverse.
Okay. But what we normally do is that we just calculate the variance at the total level. We compare the two. But the question can ask you to do this under planning variance and also operational variance. So you calculate it one by one and add. It will just be the same as if you calculate it at once. Okay, so we normally combine the planning and the operational to calculate it. Okay, but this one, the question is actually, no, this is sales. This is sales. So it's supposed, you are saying that you are going to be selling 5,200. Now you have sold 5,400. That is going in your favor. This is not cost. No, this is not cost. This is sales. If you sell more, it is in your favor. If you sell less, it's against you. So that is why it is favorable. All right. So, Senior, I hope you have now understand the planning and operational variances, how we go about it. All right. So that is not the issue now. Let's calculate our revised budget. So revised budget for the year. Okay. So what is our demand now? Revised demand is what? 5,200. Okay. So let's come to our revenue. What will be our revenue based on this? Okay. What are we estimating? What is our budgeted revenue for? 6,000.
Hello, sir.
Yes, Senior.
Good evening. Please, which question are we solving? I just joined, so
Question number one.
question number one. All right. Thank you very much.
All right. So our budget is what? Our budget is for 6,000 meals. And the total revenue for that is what?
45,000.
Okay. So if 6,000 is equal to 45,000, how much will be equal to 5,200? Okay.
39,000.
So we have 5,200 divided by 6,000 multiplied by 45,000. What are we having?
39,000.
39,000. Okay. Let's come to our variable cost. Our variable cost is what? Is 5,200 divided by 6,000 multiplied by the cost for that is how much? 26,400. So 26,400. What are we having?
22,880.
20.
2,880.
Okay. Since you are doing management accounting, show your contribution. What will be our contribution?
$16,120.
Okay. Then we bring the fixed cost. What will be the fixed cost? I'm waiting for someone to mention it for me so that we can give the person the boss of the day. What will be the fixed cost for the 5,200?
5,250.
5,250. Why?
495.
First call doesn't 4950.
No.
49.
We are doing the
Fixed
4,950
cost
is
is
for
5250.
the fixed cost is what?
5250.
Why? Why 5,250?
Because at that
Fixed cost won't change.
Okay. So the fixed cost will still be 5,250. Okay. Fixed cost, it is fixed. Even if you are producing 1 unit, you still incur the same cost. So we don't flex fixed cost unless a part of it is variable. We only flex the variable items. We only flex the variable what? Cost. Because they are the costs that will be what? Increasing or reducing as output level increases or decreases. So the revenue, it is a unit that we are going to be selling. So the cost is per unit. So if we sell more, we are going to be getting more. If you sell less, we are going to be getting less. So the revenue will now be varying with what? With the output level. Okay. Someone can also calculate the revenue by 45,000 divided by 6,000. The person can get the revenue cost per unit or the selling price per unit. And now, some people also, okay. So someone can also calculate the selling price per unit, the budgeted selling price per unit. Then the person will multiply by 5,200. How much is 1 unit? And now we are selling 5,200. How much are we going to be getting? Someone is asking why not actual? Actual is 5,400. Okay, that is actual fixed cost incurred. We are not going to be knowing the actual until the production is done. We are still doing this at the what? At the planning level, which is a tactical level. So the actual performance has not yet taken place. Our target has not been given to the operational level to operate. Actual will be after everything has been done for the period, and we know these are the actual costs that we have incurred. We are still doing this at the planning level. So the actual, we have no idea about the actual. Okay, so what will be your profits?
10870.
So 10870. Okay, so that is your revised budget. Very simple. It's not a big deal. It's very simple, but you need to think. You need to think.
Hello, sir.
Yes, please.
From what we've done, it means that we revised the budget at the planning level.
Okay.
I don't know if I'm right. And
Okay.
if I'm right, then my question is why the planning level, since the question didn't specify?
No, the budget will be revised. Okay. I have no idea about you are selling. You are okay. I'm the owner of the business. Okay. So you people you go there and sell. You are the supervisor. So I'll prepare the estimate. I'll prepare the estimate for the period. Okay. I'll prepare the estimate for the period, and I'll give you the estimates. I have no idea about how you people you do your things, but I'm saying that this is what I think we should do. Okay, you the manager, you look at it and say, no, boss, how things are, you don't think we can be able to do this. Then you now tell me that, okay, based on how the market moves or based on the conditions in the market, this is how the things will be done. So the two of us will now revise the budget. So maybe I'm giving you 5,000, you understand or no? The way things are, we cannot achieve the 5,000, so it can be 4,800. We now revise the budget between us. So my 5,000 has now fallen to what? 4,800. So there's a difference of 200 between the two of us. That's what we call the planning variance. What is happening between you and myself? The employees are not part. They are going to be the people that will take out that particular activity. So they are at the operational level. They are going to be implementing the targets. Okay, you will now take the 4,800 and now give it to the employees that, okay, this is the target for the period. So they have to implement it. At the end of the period, the employees will do their work and you now look at it. So the revised budget is always done between the top and the middle, which is between you and I. The employees are not involved.
Okay.
Uh,
Thank you.
You're welcome. Okay. Please, they have not examined planning and operational variances before. It is part of the advanced variances. Okay. So it is either you unlearn what you have learned to learn new things, or you decide to just move on and we all move on. Okay. Let's come to what you know. Okay, what you know already. Prepare a performance report for the month based on what? Flex budget. So the flex budget, what we do is that it is the actual variance that we calculated. So we ignore the planning and operational, just that we just look at the difference at once. We have estimated for 6,000 and they have sold what? 5,400. So what is the variance resulting from this. That is what we are going to be doing. That is a flexible budget. We compare our fixed budget to our actual budget. So we just find the variance, the total variance, by ignoring the planning and the operational variances. So we'll be comparing our fixed budget, which is 6,000, to the actual results. So this is why we have the flexible budget itself. Okay, so you have the flexible budget itself. So we have the B part, we have the flexible budget. So what we do is that we have the flexed, we have the actual. The actual, you won't do anything. Okay, so you now have your variance. Okay, you budgeted for 6,000. Now they have sold 5,400. Can you compare 6,000 result for 6,000 to 5,400? Can you compare these two results?
No.
Okay. So what do you have to do? You have to make sure that they all have the same basis of comparison, isn't it? Okay. So you have to bring your budget. You have to bring your budget to. You have to bring your budget now to what? To the actual level. I'm saying that I'm going to be taking 10 people to the farm, and I'm saying that I'm going to cook for them maybe 10,000 Ghana cedis. The money that I will spend on them is 10,000 Ghana cedis. Now I've taken only 6 people to the farm, and I'll spend 15,000. I cannot compare 10,000 that was budgeted for 10 people to what? 15,000 that has been spent on what? 6 people. You ask yourself, based on your budget, how much do you have spent on the 6 people? This is the amount I'm supposed to spend. And how much was actually spent? Then you compare the two. So we have to bring our budget now to the level of the actual so that we can compare. That is all about the variance. We are budgeting for 6,000 and the revenue over there is 45,000. Okay, if 45,000 is 6,000, then how much will be for 5,400? That is what we do. So we now bring our budget now to, so we have the actual here, actual meals to be 5,400. We now flex our budget to reflect the actual. So we can now have our currency sign here, our currency sign here, our currency sign here. Let's have revenue. Okay, you can calculate the revenue in a bracket here. So 5,400 divided by 6,000 multiplied by 45,000. Okay, or you can also calculate that like this. The revenue can be calculated like this. Okay, we are saying that we are going to be getting 45,000 from selling 6,000. Okay, so what will be the price per meal?
7.5.
Okay, so if the price per meal is 7.5, that is the price, budgeted price. We have now sold 5,400. So what will be the amount that we'll be getting? That will be 7.5 multiplied by 5,400. Okay.
Get 40,500.
Okay, so that will be the same as the 5,400 divided by 6,000 multiplied by 45,000. I'm getting 4,500.
Yeah.
Yes.
What is the actual amount received?
Thirty, 365.
The actual amount received is 40,365.
365.
Okay. Are we receiving more or we are receiving less based on our budget?
We are receiving less.
So this is revenue. The difference is what? 135, isn't it?
Yes.
Okay, 135
Adverse.
adverse, or you can put it in bracket and move on. Okay, or you can just put it positive and add the adverse to it. Let's come to variable costs. Okay, we assume that all the variable costs and then the revenue are going to vary with the output level. So 5,400 divided by 6,000 multiplied by 26,400. What are we having? I'm having 23, 7, 6,
23, 7, 6.
Okay. What is the actual amount?
24632.
24,632.
Okay. 24632. Are we spending more or we are spending less?
We are spending less.
Okay. So that
We
will
are
be
spending less.
no.
More.
Okay. Based on our budget, we should have spent 23,760, but we ended up spending what? 24,632 to produce that. So it means that our expenditure has increased. So that will also be adverse. You can put it in a bracket. Let's come to our contribution. Okay, since we are doing this for management accounting, we need to show our contribution. What will be our contribution? 4,500 minus 23,760. I'm having 16,740.
Yes, 16,740.
Okay, 135 plus 370. Okay, what will be the
15,733 for actual.
okay 15? Okay, so we have 15,733 for actual. What is going to be the total? I'm having 1,007.
1,007.
Okay, so let's come to fixed cost. What will be the fixed cost over here? 5250, 4950. What is happening to the fixed cost? Are we spending more or we are spending less?
We are spending less.
Okay, by how much? 300.
Spending less.
I'm having 300 less.
Yes.
300.
Okay, so this will be
Favorable.
positive. Okay, so this will be 707.
114. The flex.
Okay,
Profit for flex. 11490.
114. Okay, the actual is what?
The actual is 10783.
107.
783.
783.
Okay, so you have your profit. So this is the second part.
Sir,
Yes, please.
please. Is flexible budget the same as flex budget?
Okay, the flex budget is this side. This side is the flex budget. But if you compare the actual with the flex, is what we call the flexible budget. But the question is saying that you
Okay.
should prepare performance report. So it means that you have to report, you have to show the two issues. Okay. You have to show the
Okay.
actual with the what? With the flex one. Okay.
Hello, sir.
Yes, yeah.
Let me also ask you this, if that is also okay. With the budget, I was thinking that I would divide the 45,000. No, please come to the question and let me just show you. Okay, sir. So if I divide the 45,000 divided by 6,000, I will get 7.5.
Okay.
And I'll multiply the 7.5 by the 5,400.
We have done that. We have done one.
For the,
Yeah, I've done
then,
one. Okay.
oh, okay, sir. Oh, okay.
So,
All right, thank you.
so I said that you can also do it like that. If
Okay, sir.
fine by
All
you,
right,
yeah. Thank
all
you.
right, sir. Thank you. Thank you.
You're welcome, senior. Okay, let's move on. Yeah, Senior Ben, I hope you're okay now. Okay. Yes, you have done well.
Yes, yes.
We are very fine. Senior Rico, are you there? Okay.
Yes, I'm here.
Okay. So some of you have checked the script. Yeah, you have done well. So with no, like with the grace I have, you have passed the exam already. Okay. So yeah, don't say amen because the amen will not do anything. You have to put in the effort. So just say, oh, God will do it and leave the amen alone. Okay, let's come to the C part. So that is basically about that. Explain two non-financial measures that the Delta Limited could use to monitor the performance of the new fast food restaurants. So you can see that what we have done over here are all financial measures, isn't it? What are other issues that we cannot use money? We cannot measure in monetary terms. What are other issues that we can use to measure the performance of what? Of the restaurants, other non-financial measures. Two, or we can mention more than the two. Maybe in that situation, you can be able to mention at least two of these ones. Okay. What are other, apart from using our flex budget and other issues, what are other factors that we cannot quantify in monetary terms that can be used to measure how well the restaurant is doing? Yes, Senior.
Okay, so
Senior.
we can use customer satisfaction.
Okay.
Yeah, service delivery.
Okay, we can also use our, okay. So yeah, that is, if you say customer satisfaction, that will not be bad, but I think it should be simplified a lot. It should be simplified a bit, but that is not fine. We will polish it, so don't worry. And the service delivery also, isn't it?
Yeah, please. Yeah, responsiveness.
Okay. Yeah, you said?
Responsiveness.
Okay, so let me finish with the service delivery and we come to the responsiveness. Okay. Okay. Yeah, what again? We will polish all of them to make it a point, a better point. This one, they just say, okay, they say explain, so you can state and add why and what you mean by the customer satisfaction. You are going to explain that. But if you are asked to state, it means I should be in a sentence form. Okay, so we polish on, we look at that and see what will happen. Yeah, any other factors?
Hello, Senior.
Yes, yeah. Yeah, Senior, I'm with you.
Hello,
Yeah, I'm with you, Senior.
Senior.
Yeah, I'm with you.
Hello.
I can hear you, Senior.
I beg, can the customer complain?
Okay, the
Customer
complaint,
complaint, can it stand alone or it will be
the
under
yeah, it
customer
depends.
satisfaction?
It depends on how you are. With the customer satisfaction, we have a lot of issues there. It can be the number of the repeated orders that the customer, like the repeated orders received from customers. That can also be part of the customer satisfaction. The complaints can also be part of the customer satisfaction. Okay. So the recommendation given by the customers also can be under customer satisfaction, because if people are satisfied, they are going to be recommending. If they are satisfied, they are going to be buying more. If they are satisfied, the complaint will be very low. Okay, so we can factor all those things under the customer satisfaction. That's why I'm saying that you should, yes, the quality of the food is also nice, and that will also be under the service. Maybe, okay, the food is a different thing from the service. But if you are not writing the customer satisfaction, okay, then write the number of complaints or the customer complaints, or maybe recommendation by the customers, or repeated orders from what existing customers. You can use that ones to write it. Okay. So the person who is writing the customer satisfaction depends on how he is going to be what? He is going to be looking at this. Someone is saying employees turnover. So if the workplace is good, you see that people will be there forever. So if the organization is not doing well, people will be leaving. So the turnover is also another factor there. Okay. Someone is saying the environment. So to some extent, I don't take a wrong answer, but you just have to convince me. Okay, so okay, the staff training too is not bad, but you just have to convince me. But those that are directly related to this one is the ones that we have over here. Okay, quality of the food. Okay, quality of the food. That is also okay. And yeah, I was saying two. Okay, so
Number of orders.
what about
Number of orders.
okay? So the number of orders we have factored that one under the what under the customer satisfaction, because if people are actually satisfied, they will be recommending and people will be buying. Okay, so the number of orders.
Reliability.
Okay, reliability can also be okay. Please, there is no wrong answer. Just try to explain what you mean by what you are saying. Don't just write the points. Okay, some points you are not sure. So you need to add something to it, just like you are cooking a diet for the first time. You haven't tried that before. So you have to do everything possible to make it nice. So you have to add what's supposed to be added. Okay. So referral from customers, that is also fine. So that is
Number of new customers.
okay. That is also going to be fine. And yes, so that is the non-financial issues. Okay, we can say the repeated what orders, what existing customers, the referrals being made by the customers, the number of what number of complaints received from customers, and also the rejection. We can also look at the what the rejection of our items, the quality of our service also, and also the staff turnover. Are people leaving? If people are not leaving, it means that the place is good and we are doing what we are paying them. That's why they are still staying there. Okay. Yeah, Rico, I saw hand up.
Good evening.
Yes, yes, yeah.
I just want to find out by reading the question, the face value, is there any indication that shows that you have to use the planning level?
Okay.
I don't know whether you get my question. For the reading of the question, is there any indication? Maybe this indication shows that the budget was prepared under the planning level, or maybe top management level.
This is a sales volume contribution. So the question now is, how do we calculate sales volume sales volume planning, sales volume contribution planning variance? This planning variance is between the top and the middle. Okay, so it means that since they are calculating sales volume planning variance, it means that the budget has been revised and they are asking you to prepare a revised budget. So you just have to look for the revised estimate now and use it to prepare your revised budget. So it's because of this that we are doing that, and also the question over here. If this question is not here, then it means that we just do our normal flexible budget and move on. Are you okay?
Thank you very much.
All right. All right. Okay. So let's take the small bets. Mighty question number 2, which has all the basic side of what budgeting. So let's take that. Then we now enter the issues of what variance analysis. Question number 2.
Rosina, can you hear me?
Yeah, I'm with you, Sina.
Okay. I cannot see the beginning of the question.
Oh, really? Okay.
Okay.
Are you guys
Has
aware that
just
we have class at dawn?
negotiated a contract to supply.
Are you guys aware that we have class at dawn?
No.
Oh, today.
Yes, sir. We are aware, sir.
Hey, Africa, there.
Yes, sir. We are aware.
Every day I'm getting confession that or evidence that Africa, our problem is reading. Okay, I will be there. Someone will say, when is the intervention starting? So I have to send a flyer again, and I will check the person is part of the page. I say, wow, Oh no. We should find interest in reading. Someone will say it's special. Eric will say that it's special, but we have all been under this situation.
It's special.
Question
It's
number
special.
two.
It's special.
Question number two. We have all been under that pressure before. Okay. So what about those of us that?
Listen here.
Yes, yeah. Yes, now you can move on now.
Okay. John Bada has just negotiated a contract to supply 8,160 decks to all the primary schools in Muchinga province. This is the breakthrough he has been waiting for, and he has decided to start the business he has been planning for months now. The Top Desk Company Limited. The Ministry of General Education, which is responsible of ensuring good learning conditions in all schools, including primary schools, has agreed to pay 255 cedis for each desk and wants them all delivered next year, which is 2018. John wishes to supply all the desks within the first 6 months of 2018, starting January 2018. His projection is to supply and deliver the desks evenly over the 6 month period, with no inventory at the start of January 2018 and at the end of the 6 month period, as these desks are specifically for the schools in Moshinga. John has opted to maintain closing inventory over the period equal to the following monthly supply. January is 100%, February 50, March 50. Please, can they scroll up?
Senior, can you see the question?
Okay, I can see now. The ministry has advised that payment will be made the month following delivery, as the procurement officers at the schools have to thoroughly inspect the desks. John has sourced a supplier who will supply the materials required to produce the desk at a price of 15 Ghana cedis per kg of material. He is hopeful that the ministry will ask for more desks in the near future. As he is a new customer, the supplier is unwilling to give him longer credit, and he will be required to pay for the materials when they are delivered, which is the same month production takes place. His buying pattern is to buy as much materials as is needed for production in that month. He will keep inventory of materials at 30% of the following month's production requirement. Although in June 2018, he intends to keep it at 20% of that month's production requirement. This is to allow for production of any desk that might be damaged during transportation. On average, he uses 10 kg of material to make a desk, and this is unlikely to change over the period. John will need machinery to allow him to make the desk. He has seen a new machine at the recent trade show at a cost of 80,000 Ghana cedis that he has opted to buy. He will need to pay for this machine when it is delivered in January 2018. The business plan shows that the monthly overheads of the new business will be 20,000 Ghana cedis payable in the same month they are incurred. In addition, delivery costs have been estimated at 9% of revenue payable in the same month revenue is earned. In addition, delivery costs have been estimated at 9% of revenue payable in the same month revenue is earned. To make sure he and his family have enough to live on, John will pay himself a monthly salary of 9,000 in January 2018, increasing by 10% in February, March, and April. He will then maintain the April level for the rest of the period. He has 50,000 Ghana cedis saved up that he will pay into the business bank account in January 2018 to get the business started. John has heard that you are studying for your CA and he has asked for some help in budgeting for the business. Required. Senior, please go up. Prepare the following functional budgets for the 6 months to 30th June 2018. Sales budget in units and value. Production budget in units. Material purchases budget in kg and value. Cash budget.
Okay. So yes, you see that thank you, Senior. You can see that this thing is plenty, isn't it? You don't have to read everything. Okay, so the first thing that you have to do is that you have to look at the requirements. Okay, look at the requirements here. They are asking you to prepare sales budget in unit and value. They are asking you to prepare production budget in unit. They are asking you to prepare material purchases budget in kilogram and value, and also cash budget. The question is, how do we prepare our sales budget? We are going to do this for the first 6 months of the year, which is 2018, January to June. So we need to know the quantity that they are going to be selling in each of the months. That will be for units. Then we now multiply the quantity by the selling price per the quantity. That will give us a sales budget in value. So you just read your requirements. You are looking for sales budget. So what are the items do I need for sales budget? You scan through the question, read the portion that are important to get your sales budget. Read the portions that are important to get your what? Your sales budget. You don't have to take your time to be reading this. It is going to waste your time. Identify the requirements, look for the items that you are going to be using there. So you don't have to read this one from the beginning. You can see that the time that you were reading, you wasted about 5 minutes reading this. And so, this one, you see some of the items, then you have to think about it again. All right. The question is, what is the total number of desks that they are supplying? What is the total number of desks that they are going to be selling to the ministry?
8,160.
Okay, let's come here. His projection is to supply what? John wishes to supply all the desks within the first 6 months. Okay, so all these things will be provided. They are going to use 6 months to provide all the 8,160. His projection is to supply and deliver the desks evenly over the 6-month period. So it means that equal number of desks will be delivered in each month. Is that correct?
Yeah.
Okay. So let's look at the number of desks that will be delivered each month. So let's look at question number 2. That will be John. Okay. So what will be the number of desks that will be delivered each month?
1,360.
Okay, so that will be 8,160 divided by 6. That will be 1,360 desks, isn't it? Okay. So we can,
Yes, sir.
from here, we can do our sales budget.
Yes.
Very simple. So we have sales budget in units and value. Okay, we know the quantity that we'll be selling now, so we don't have to waste your time again. So you come to do the month one by one. So let's have the January here. Let's have February. Let's have March. Let's have April. Let's have May. Okay, let me just go and do the sales budget here so that it will be better for us to see. Okay, so let's have our A here, the sales budget. So the sales department will prepare these budgets in units and value. So they are saying that every month we are going to be selling 1360. So we can have our January here, our February here, our March here, our April here, our May here, and we have the June here. Are we okay with that? Okay. So we can have units here, units at the top, units at the top, units at the top, units at the top, units at the top. Okay. So we can have the demand. Okay. We know that every month is 1360.
Linus,
Yes, please.
sir, please. My network went off. Can you go back to the A1? Why we are dividing it by 6? Please. Can you do that for me, please?
Okay. Please, can someone help our dear brother with this one? We are all learning.
Okay.
Okay.
If you look at the question, the number of deaths to supply in the question, we have 8,160. And it says that it will be supplied evenly for the month. It will be supplied evenly. So we have 6 months. So it means that if it will supply evenly, then it means we divide the number of deaths by the 6 months, which we are going to have 1,360. So the demand for each month will be 1,360.
Thank you very much, senior.
So I hope you're okay now.
All right.
I've cycled
Yes, sir.
the place that you have to see the information there. All right. Thank you, Sina. Thank you, Sina, for coming through. Okay. God will see you through the exam. All right. So let's have the 1360.
Amazed with that.
1360. But the paper is not difficult like the way people you used to see it though. Okay. So we have, let's come to the Ghana city here. The Ghana. So the first one is in the unit that they are talking about. So let's come and do it in the what? In the value now. Okay. So let's do it in a value. Okay. So doing it in value, you still bring the demand here. Okay. Someone can just use the selling price to multiply that and have the total. They can still mark it. Okay. But we are looking for more ticks. So 1360, 1360, 1360, 1360, 1360. What is the selling price per DEX?
255 cedis.
Okay, 255, 255, 255, 255, 255, 255. How much are we getting?
346,800.
Okay, for all of them, isn't it?
Yes.
3, 4, 6, 800. So 3, 4, 6, 800. 3, 4, 6, 800. Please, you have to be very fast in whatever you are doing. You have to be fast, but the accuracy also have to be very okay. So 3, 4, 6, 800. Okay. So we are done with the what? We are done with the sales budget. Sometimes they will not ask you for sales budget. Please, you cannot produce without knowing the demand of the what? Of the sales and distribution departments. Okay. So production budget is always prepared based on the sales budget. You are not going to be selling the items yourself. You are going to be producing and someone will be selling. So if you don't know the number of quantities that the people are going to be selling, how do you produce? So production budget is based on sales budget. So the question might not be asking you to prepare sales budget, but you have to know your sales for each month before you can produce or you can prepare a production budget. So we are coming to our production budget for this one. They say production budget will always be in units. Okay, production budget, we are just producing. It is the stock people that are going to be buying the raw material. They will buy the raw material and bring it. So we will just give, okay, this is our production plan for the year. So they will go now and buy the raw materials and bring it to you. Okay, so production will always be in units, not in value. Production people, they are just going to be giving, okay, this is what we want to produce. So the people that are available or that are responsible, the storekeeper or the purchasing department, they are going to be buying what the raw material and bring it to them to produce. Okay, let's come here. Assuming there is no opening and closing stock for each month, what will be the total production for each month? Assuming there is no opening stock and there is no closing stock, what would have been the production for each month?
130.
Okay, that would have been 1360, isn't it? Okay, so let's come to the production budget. Very interesting. Assuming we are not keeping any stock. we have to produce what the sales department will be selling. So we have the production budget. Okay, we have the production budget. Okay. There will not be any opening inventory for January. Why? I know there will not be any opening inventory, but I don't want to know why.
Because that is the first time the company is starting its operation.
Exactly. Why? Are you telling us that you have a material that you are keeping somewhere that, okay, demand will come and you start producing now? This is the first time. This is the first time that what they are coming to produce. So there will not be any opening inventory for the what? For the first month. And the question will tell you, if they want to tell you, they have to tell you, but I'm not sure there's an area over here. So what will happen is that what is the quantity that we want to keep? What is the quantity of the finished goods that we want to keep for the January? What is the closing inventory that we want to keep?
1360.
Okay, we are keeping 100%, isn't it? Okay, so
Yes.
we have to produce a certain quantity. We have to produce a certain quantity so that we give the one that the sales department will be selling, and we still keep what? A particular quantity. So what we have to produce is that we have to produce what the sales department is demanding plus what we want to keep. That would be our total production. Okay, so we will be having, so I'll bring this thing over here. So I'll bring the January over here. I'll bring the February over here. I'll bring the March over here. I'll bring the April over here. And I'll bring the May over here. And I'll bring the June over here. So this will be in units. So we can put in units here. Okay, units, units, units. Okay. All things being equal, we should be what? We should be producing 1360 every month, isn't it?
Yes, sir.
Okay. So we should be producing 1360 every month. Okay. But the first year, we want to keep a closing stock of what? We want to produce and still keep 100% of what we are producing. Okay. So let me have opening stock over here and closing stock. So I'll have opening stock and closing stock. So we'll have opening stock and let's have closing stock. Okay. First year, would there be any opening stock? First month, January.
No.
No.
Okay. But would there be any closing stock?
Yes.
Yes.
Yeah.
Closing stock of
Yeah.
1360, isn't it?
Yeah.
Yes.
This closing stock will become what?
Opening stock for
Opening
February.
stock for February.
Okay, opening stock for February. So let's come to closing stock for February. What will be the closing stock for February over there? What will be the closing stock for the February?
It will be
650.
I'm having 680.
680.
Okay. They are saying that John has opted to maintain closing inventory over the period equal to the following month supply. Following month supply is the sales. So how many quantity are you going to be supplying? That is the following month. How many quantity are you going to be selling? That is a what? That is a sale. So we are keeping 50% of the sales for February, and that will give us 680. Okay. So we have 680. Okay. So let's come here. Let me use the opening stock. Okay. What is the quantity that we have to produce in February?
640.
No, let's just assuming nothing is going to happen. We have to produce 1360, isn't it? There's
1360.
no opening stock. Okay. But what is happening here? We can see that we are keeping a closing stock of what? 1360 in the first month. Okay. If there will not be any opening stock, or if there will not be any closing stock in what? In February, do we have to produce?
No.
We have to produce. If there will not be any quantity in, if there will not be any quantity, any closing stock in February, you can see that the first month we are producing, or first month, how much is the production for the first month? We're having 2720, isn't it?
Yeah.
Okay. So I'm saying that assuming in the second month, okay, in the second month, there is no closing stock. There will not be any closing stock. It means that in second month, we don't have to touch the machine because we have produced the second month in the first month already. We'll be giving 1360 and 1360 will be given to them. So the 1360 has already been provided. So assuming there will not be any closing stock in the February, we are not going to be producing. What am I trying to tell you? I'm trying to tell you that the opening stock will always be what? Subtracted from your what? From your sales figure, and you add your closing stock. Why? Why? Why do you
So
think?
because we want to,
Then you more
because we
than
want to determine the number of units we've actually produced in a month. We've
Yes.
added
We want to know the production for that particular month. How many quantities we produce for that particular month? Let's come here. Okay, let me use this example for you. Assuming the demand is 6,000. Okay, we want to sell 6,000, but we already have 2,000. How many quantities do we have to produce?
4,000.
We have to produce 4,000. How do we get a 4,000? You have 2,000 already. So you produce 4,000 addition. So it means that you subtract the 2,000 from this one to get your production. Because you have 2,000 already, produce 4,000 addition and have your total amount. But let's say that after selling the selling the 6,000, we still want to have a closing stock of what? Of 3,000. We want to sell 6,000 and we want to have a closing stock of 3,000, but we already have what? 2,000 in stock. How many quantities do we have to produce?
7,000.
We have to produce 7,000, isn't it?
Yeah.
Okay, so this is calculated as 6,000 minus 2,000 plus 3,000. Okay, this is the sales, this is the opening stock, and this is the closing stock. So your opening stock will always be subtracted from your this one. So let's come here. Opening stock will be in brackets. 680 will be our opening stock for the March. Is that correct?
March. Yes.
Okay. What will be the closing stock for March? They have given us that figure. They have given us a percentage there. That will also be 50, isn't it?
Yes.
Okay. So we have 680 here.
That's also 680.
Okay. This 680 will be what? Opening
The
stock for
opening
what?
for April.
Okay. So what will be for closing stock for April?
408.
Okay. Okay. So that will be 408. That 408 will be opening stock for
May.
Okay, so 408, that will be opening stock for May. Okay. So what will be the closing stock for May?
68.
68. Okay. So that will be 68. This 68 will be opening stock for June. Do you have any closing stock for June?
No.
Okay, so that will be dash. Okay. So let's now calculate the production for every month. So I'm sure this will be 2720.
Right. I think why all the opening stock negative?
We are subtracting. So that's why I'm putting it in brackets. We are going to
Okay.
So 13. This will be 680. Is that correct?
Yeah.
Yes, please.
Yeah, 80.
The closing stock for April,
Yeah.
which is 408,
Yeah.
is not in brackets. I thought that was supposed to be the opening stock for May, but we've kept that one in brackets. Is there a reason?
Which one?
408 closing stock for.
We're not deducting the closing stock. So.
Closing stock, we are adding the closing stock. Closing stock will be produced in addition to what we are selling. So that is what we are adding. But if you want to sell and you have what? If you want to produce and you have some quantity already, you ask yourself, how many quantity do I want to sell? And how many quantity do I have available? So how many quantity do I have to produce? So if you have if you want to produce 6,000, you want to sell 6,000, you have 2,000 already, which is the opening stock. It means that you have to produce 4,000. How do we get a 4,000? We subtract the opening stock from this. Okay. But if you want to sell 6,000, but you still want to keep 2,000 for the next month, it means that you have to produce 8,000. How did we get the 8,000? We add the closing stock. The closing stock will be produced together with what we are going to be selling. So the closing stock will be added and the opening stock will be subtracting. That is why we are subtracting. So closing stock for 1 month will become opening stock for the subsequent month. Closing stock for January or closing stock for 2021 will be an opening stock for what? 2022. The same thing that we are doing here. Opening stock for February was closing stock for what? January. Closing stock for March will be an opening stock for what? For April. That's what we are doing. So it's just the basic accounting issues. I don't know whether you're okay.
Okay, so the 2720, is it in the question or you?
We
You
want
got it.
no, we want to sell. We are selling 1360 every month. Okay. We want to produce and keep a closing inventory of 100%. It means that we will sell the 1360 and still keep 100% of that the 1360 in our shop again. So we have to produce 1362 times. One will be given to the sales department. That is what they want to sell. And one will be kept with us, which is 100%. So we will give 1360 to the sales department and we keep what? 1360 with ourselves. It means that we have to produce 2 times the what? The demand. That is 100%. So I have the 1360 plus the closing stock of 1360. That is a 27220.
All right.
Okay. Would a third month be 1360?
Yes, sir.
Okay. So what are we going to be having? 1360 minus 680 minus 408.
1088.
I'm coming. It seems like this thing plus 408. I'm coming 1088.
Yes,
Yes,
1088.
Yes, 1088.
The fifth month
And
is
then
what?
1020.
Okay, 10.
1020.
Okay, 1020. And the last one,
1292.
1292. So these are the production requirements for what? For each of the months. So we are done with the production budget. Nothing difficult. All right. Let's come to the C.
Sir,
Yes, please.
sir, please, I don't understand the 2720, the first one, the production. I don't know how we are right.
We have 1360 already, and we are adding another 13. We have a figure starting from here. The figure is starting from here. So we have 1360. There's dash here plus 1360. That's it.
Oh, okay. Okay. Thank you.
So we have the purchases, the material purchases budget. Okay. The material purchases budget. If you want to prepare the material purchases budget, you always have to prepare the material usage budget. Okay. You have to know the quantity that you'll be using before you go and purchase. So the material purchases budget in units, and in value. We have to look at that. Okay. So first of all, before you know the quantity that you are going to be you are going to be buying, you need to know the quantity that you are going to be using. Okay. If I'm producing 2,000 units and every unit I'm using 10 kilograms, what is the quantity of material that I have to go and buy? All things being equal. What will be the quantity of material that I'll be using? I'll be using 20,000 kilograms. Okay. If I don't have any opening stock of the material and I don't want to keep any closing stock, it means I'm going to buy all the 20,000 and use it, isn't it? Okay. But if I have 2,000 kilograms of the material already, how many quantities am I going to be buying?
You buy 18,000.
So you have 20,000 kilograms minus what I already want that I have. Okay. If I want to buy the material such that I will still have 3,000 After using it, I'll still have the 3,000 kilogram, assuming there is no opening stock. I'm going to be using 20,000 kilogram, but I want to buy, so that after using the 20,000 kilogram, I'll still be left with what, 3,000. How many quantities will I buy?
Please come again with the question.
Okay, I'm saying that we all agree that I'm going to be using 20,000 kilogram, isn't it? Okay.
Yes, please.
Okay, but due to the demand or due to the shortage or due to the nature of the material, I want to use the 20,000. I want to buy the material so that after using the 20,000, I will still have 3,000 left. How many quantities am I going to be buying?
5,000.
By 21,000 if you are having 2,000.
No, let's assume that the opening stock is not there.
You buy 23.
I'll buy 23. Okay, I'll buy 23 so that after using the 20,000, I'll be left with what? The 3,000. Okay. Consider the closing stock, we are adding the closing stock. The material purchases budget all follow the same principle like production budget. If you have opening stock, subtract. If you have closing stock, add. That's how we are doing here. You consider we are subtracting the opening stock of 2,000 from our usage. We are adding 3,000 to our usage. If you want to have a closing stock, it means that you are going to buy a material that you'll be using. You are selling rice. Watch it. Anytime at all that you want to produce or you want to, I don't know whether you are going to be producing, anytime at all that you want to cook, you use like 20 tin tomatoes. Okay, so whether you like it or not, you have to go to the market and buy the 20 tomatoes. Okay, but the issue now is you have 5 already. You have to go and buy 15. So that if you add the 15 to the 5, you have the 20 that you'll be using. Okay, you don't have any. You want to buy it in such a way that after using the 20, you still have 10 remaining so that you can use it the next day. It means that if you go to the market, you have to buy 30. Why? I'll be using 10, I'll be using 20, and what? Keeping what? 10. So I have to go there and buy 30. If I buy 20, I will not be having 10 left. So I have to buy 30 so that if I use the 20, I will be left with what? The 10. That's how we add the closing stock always to what? To the requirement. And opening stock will be what? Will be reducing. Opening stock will be what? Will be reducing our this. But what do you have to do? You have to know the material usage first. What is the material that we are going to be using? You have to know the material that you are going to be using, the quantity of material that you are going to be using before you can decide the number of quantity that you are going to be you are going to be buying. So we need to have January here. We need to have January here. We need to have February here. Okay, let me just expand this because I'm using the full board. So I have January, I have February, I have March, I have April, I have May, and I have, do you have anyone called by May? Do you have anyone whose name is May here? Okay, because my own is June, so I think I should have a brother here. Okay, so please don't be scared. Look at the question, read to understand. Even if you don't understand, make an attempt. It's very important. Okay, what is our production requirements? What is our production for the first?
2720.
Okay, we are producing 2720, 680,
680.
1088, 1030, and I have 1290. Is that correct? Okay.
Yes.
But these are finished goods. Those are the goods that we are producing each month. What is the quantity that we are using? What is our material? How many quantities are we using?
10.
We are using 10. Okay.
15.
No, the 15 is cost. 15 cedis per kilogram. 1 kilogram is 15 cedis. Okay. On average, he uses 10 kilogram of material to make a desk. And this is unlikely to change over the period. So every desk, we are using 10 kilogram. Okay. If you are making 2 decks, how many kilogram are you going to be using?
20.
If you are producing 3, how many are you going to be using?
30.
If you are producing 100, what are you going to be using?
1,000.
Okay, so you can see that you are multiplying the quantity by what? By the requirement. So you come here, have the quantity requirement. So that will be 10 kilogram. So we multiply every of these by 10 kilogram to know the quantity that we are going to be.
Just fill in the gap, just add dash, for ChatGPT to fill in the gap. So filling the gap is another form of code.
Who is doing multiple learning? All right. So how many quantity are we going to be using? What will be the usage? Okay. So what will be the material that we'll be using to produce the 27?
27,200.
Okay, that will be 27,200. Okay. So this will be
6,800.
6,800.
6,800.
This will be
13,600.
13,600. This will be 10,880.
10,880.
Okay.
10,200.
12,920.
12,920.
Okay. So this is the quantity that we are going to be using. Assuming you don't have any opening stock, you don't have any closing stock, we have to go to the market each month and buy this quantity because we want to produce 2720 for the first month. And each desk is using 10 kilograms. So we have to purchase 27,200 kilograms of material. Okay. If we are not having opening or closing stock, it means that we have to go to the market and purchase this for all of them. But let's check the question and see if the John is keeping any inventory for the finished goods. He will keep inventory of materials at 30% of the following month's production requirements. Although in June 2018, he intends to keep it at what? 20% of that month's production requirements. So closing inventory for each month is what? Is 30% of the following month what? Material usage. Is that correct?
Yes, sir.
Okay. So it means that the first month there will not be opening stock, isn't it?
Yeah.
Okay. There will not be opening stock here. Okay. But what will be the closing stock for the first month? That will be 30% of February's what requirement following month. Okay, so this will be dash. So we have 0.3 multiplied by 6,800. Okay, I'm getting 2040.
Yes, sir.
Okay, we add. This will become opening stock for what? February, isn't it? Okay. So closing stock for February will be what? 30% of March, 13,600. What are we having? 4080. This will become opening stock for March. Okay. Closing stock of March will be 30% of April. So 0.2 multiplied. Okay, 3264. Okay. What will be, this will become opening stock over here. What will be the closing stock for April? That will be 30% of what? 10,200. I'm having 3060. Can someone confirm that?
Yes, sir.
Okay. What will be the opening stock? This will become opening stock in May. Okay. What will be the closing stock for? What will be, so we have 3060. What will be the closing stock for May? I'm getting 3878.
76.
Okay. So this will be 3876. What will be the closing stock for June? Very interesting. You have to go there.
2584.
He intends to keep it at 20% of, okay, he intends to keep it at 20% of that month's production requirement. So that particular one will be 20% of the June one again. Okay, how much are we getting?
2584.
Okay,
2584.
Okay, so let's put all of them together. and now have our material purchase, the quantity that we have to go and buy. So the first month is what? $27,200 plus 20,400. I'm getting 29,240.
Yes, sir.
Okay, 29,240. Okay. Second month will be what?
Hey, zama remote wana.
8840. Okay. So we have 8840. Okay. Then we have the third month. Please, let's hurry up with the addition so that we can let's all get involved so that we can move on fast. 3264. I'm having 12,784.
Yes, please.
Okay. 12,784. Okay, what will be for April? 10,880 minus 3264 plus 3060. I'm getting 10,676.
Yes.
Okay. 10. Okay. 10,676. Okay. And okay. 11.
It's 11016.
Okay. 11016. And the last one is what?
11628.
11628.
Okay. 11628. Okay. We are now coming to this is in unit 2. We are still under the unit. We come to the value, material purchase in value. So material purchase in value. So let's come to the value. The value, you now have the currency sign here. You now have the currency sign here. You now have your currency sign here. You have now currency sign here. Okay. What is the quantity that we are purchasing? So the quantity that we are purchasing for the first one will be 29240. Is that correct? 8840, 12784, 10,676, 11016, and 11628. Is that correct? Okay. What is our rate? Our rate per kilogram. How much are we buying one?
15.
Okay, so we are going to be paying 15 cedis for each quantity. So for you to find the total amount, you multiply your quantity by 15 cedis. So that will be the rate. How much are we getting for the first one?
438,600.
438.
600.
Okay, 438,600. Second one is what?
132,600.
132,600. Okay, third one is
191,760.
Okay.
One 140.
160. Okay, I've done that one already. So 165,240.
165,240.
Okay, the last one is what? 174420. Are we okay with that? Yeah. So okay. So that is, let's come to cash budget. So the cash budget is not anything. So let's kill that one. Then I have to talk about high or low. I hope you have heard about high or low already. High or low before. So I have a video on that, which is for the intro to management accounting student. But in that particular video, I have explained the high or low basis more than what? More than the how we do it in management accounting, because we assume that you have the knowledge from the intro to management accounting level. So let's come to the D part, which is cash budget. So we have the cash budget for the for the first 6 months, for the first 6 months of 2018. So we do it for each of the months. So let's have our January here. Please, they are not asking to show total, so don't show total. Okay, unless the question asks you to show total. So we have March here, we have April here, we have May here, and we have June. Okay, so let's show our Ghana city. Okay, so what we do is that we always show the cash flow, the net cash flow for the year. Then we add our opening balance, or you can even start with the opening balance, just like how you prepare your cash account. So you start with your please a minute then. Let me. Yeah, please. Someone want to get the explanation for the closing stock of January. Someone should help. As I'm trying to resolve someone is sending some this thing over here, some false information that I have to get the person out. So someone should help with the closing stock for January. Which of them are you asking for? Is it production or purchase? The person who asked the question, are you looking for production or material purchase? Which of them? Yeah, someone said she's saying that purchase.
Okay, so the question says that John wants to keep inventory levels. You want to keep inventory levels of 30% of the following month's production requirements. So meaning in January, you will keep closing stock, which will be 30% of the material that will be required in February. Do you get it? And if you go to February 2, the closing stock will be 30% of the material that will be required for production in March, in that order, except for June.
Please, can you come again?
Please, I said that the question says he wants to keep inventory level, that is the material for the material, at 30% of the following month's material requirements, which means that if you take January, they want to keep 30% of the materials that will be used for production in February as a closing inventory. And if you go to February 2, you want to keep 30% of the material to be used in March as closing inventory, except for the June, which is 20% of that month's material requirements.
Okay, so I hope the person will now be partially okay. So since you are partially okay, maybe before tomorrow morning you'll be fully okay. Okay, thank you. They have given us a lot of information. So let's now work on what? The cash items. So how can we get the cash items? So we always have the receipt here. So cash, the receipt, the money that you are receiving. So you might be receiving cash sale. cash from sales, or you might be receiving cash that you have from sales that you have made maybe previous period, or sales that you have made for this year in the what you have made this month, but to be received in the next month. That will also be a form of cash. Let's look at how they are receiving their, how are they receiving their sales? How are they collecting the money? Are we giving any information about that? This is the breakthrough to this one. The ministry has this one. It's in all schools, including this one for each month, and one then delivered next year, which is 2018. John wishes to supply and deliver openly with no inventory at the start of January and the start of 6 months. And okay, there's no information about the cash there. Let's come here.
So I think it will start from John will need machinery.
So the ministry has also advised that payment will be made the month following delivery, as procurement officers at the schools have to thoroughly inspect the decks. So it will be whenever you sell, you are going to receive the money in the next month. Are you okay? Okay, so that is the information over here. The ministry has advised that the payment will be made the following month following the delivery, as the procurement officers at the schools have to thoroughly inspect the DEXs. So it means that if you deliver today, they have to inspect and give you the money the next month, which is the month following the delivery. So let's go to the sales that we are making in in January. What is the sales value in January? I'm sure we have prepared sales budget. That is what? 6,800. Is that correct? Okay, that will be even throughout. So we have our receipts or our receivables. So we can say receivable. That one, you don't have to do anything for it. Okay. But the first month, you are not going to receive the money, but you receive 34,6,800. January will receive in February will receive in March. So 34,6,800, 34,6,800, 34,6,800, 34,6,800. We are not doing July. So June's own will be received in July, but we are not doing July. So we just leave that and move on. So we need to have another items also over there. So we have done ourselves, our receivables already. So what are we going to be having from purchases? What are they saying from the purchases? Okay, John has sourced a supplier who will supply the material required to produce a desks at a price of 15 cedis per kilogram of material. He is hopeful that the ministry will ask for more desks in the near future, as he's a new customer. The supplier is unwilling to give him longer credit and will be required to pay for the materials when they are delivered, which is the same month production take place. So whenever you purchase the material, you are going to be paying within the same month. Is that the case?
Yes, that's the question.
Okay. So we have to go to the material now. So the material purchases, the raw material that we are buying every month. January is how much? Okay. So let me come to payments here. So I can now have payments here. So I have payments, then I'll have suppliers. So suppliers, you can have raw material purchased. Okay, material, let me just write material purchases. Okay, material purchases. So the material purchases is the amount. So you go and buy 29,240 at 15. You pay this amount. So we have 48,38600, 43,8600. That is the figure there. We have 132 for 132,600. Okay, March will be what?
1917.
Okay, 760. And this will be 160, 140. Okay, we have 15165
240.
and the last one will be
73.
174420. Okay, so you can see that this is not well grouped. Okay, that can be traced to that one. So you pay for the material as there has been what they have been acquired. So there is no other issue about that again. Let's see whether we have any other cash issues here about payment here on average. Okay, John will need a machinery to allow to make the desks. He has seen a new machine at recent trade show at a cost of what 80,000 that he has opted to buy. He will need to pay for this machine when it is delivered in January. So when are we paying for the machine?
January.
Okay. So we count to January under the payment. Also, we have the machine purchase, and that will be 80,000. I hope you're okay with that. Okay. The business plan shows that monthly overhead of the new business will be what? 20,000 payable in the same months they are incurred. In addition, delivery cost has been estimated as 9% of revenue payable in the same month revenue is earned. So let's count to the overhead. So the overhead can be rent and those things. So let's count to overhead. Okay. The overhead of how much will be paid in the months in which it is what they are incurred. So 20,000 will be paid for in all the 6 months. So 20,000, 20,000, 20,000. So dash, 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 dash here. 20,000, 20,000, 20,000, 20,000. Delivery cost. Someone should help us with the calculation of the delivery cost. Delivery cost will be 9% of the revenue payable in the same month's revenue is what is earned. In addition, delivery costs have been estimated at 9% of revenue payable in the same month's revenue is earned. So what will be the 9% for every month?
31212.
Okay. So how did we get that? We have to
31212.
okay. So delivery cost.
That's 9% of the sales.
Okay, that will be 0.09 multiplied by sales of what? 34,600. Is that correct?
Yes, sir.
Okay. So that will be in the same month. So that will be every month. How much is that?
31212.
Okay, 31,212. So 31,212, 31,212, 31,212, 31,212, 31212, 31212. Okay, do we have any other payments? I'm sure the receipt is only one. Okay, let's come to the down here. To make sure he had his family, to make sure he and his family have enough to live on. Okay, John will pay himself a monthly salary of 9,000 in January, increasing by 10% in February, March, and April. He will then maintain the April level for the rest of the period. So January, what is that? This is just drawings. Are you okay? Drawings. You can make it drawings. He's taking the money for his personal use. So this is drawing. Okay. But if you can say salary paid to John or John's salary, nobody's going to beat you for that. So you can name it drawings. Okay. That will be 9,000 in the first month. Let's do some small workings for that. Okay. So let's have the salary here or the drawings. Okay. So January, February, March, April, May, and June. Okay. The first month will be 9,000, isn't it? Okay.
Yes, 9,000.
this will increase by 10%. So increasing by 10%, how much are they going to be paying in February? 9,900.
9900.
Okay. But 9,900, February will also increase by 10% in March. So how much are we going to be paying in March?
10890.
10890.
Okay. April will also increase by 10%. April,
11979.
okay, 11979. And they say April will be maintained for the remaining period. Is that correct?
Yes, sir.
Okay. So that is that for that. So we have 900. Okay. Then we have 10,890. Then we have 11979, 11979, 11979. Okay. So can we have our total receipt there? I'm not sure. So our receipt over here, this will be dash. So this will be 34,6,800. 34,6,800. 34,6,800. 34,6,800. 34,6,800. Okay. So we can name this one A. So that our net cash flow. So can we total our figures now?
Hello, sir.
Yes, please. Yeah.
So why didn't we add the capital to start the business?
The capital will become as opening balance after we have done it's an opening balance. Okay, so that will come as opening balance under the first month. Okay. So 438,600 plus 80,000 plus 20,000 plus 31,212 plus 9,000.
578812 for January.
Okay.
February 193,712.
193.
712.
Okay. Can someone give us the match?
April.
So match is 253862.
Okay. April is what?
April is 223,331.
223.
331.
Okay. The 3 is how many?
June is 223,331.
Okay. 22331. Okay. June is what?
June is 237611.
7611. Okay. May is what?
May is 228431.
2284.
Hello, Senator.
Yes, please.
My network wasn't good. I've just joined again. The delivery cost.
Yeah.
There is somewhere that it says that delivery cost is paid in the month that revenue is earned.
Yeah, revenue is earned and revenue received are the same, are two different things. Revenue is earned when the goods has been sold. So we sell in January, revenue is earned in January, but just that we are receiving in February.
The payment in February. Oh, okay.
So revenue,
all right,
when revenue is earned is when the revenue has been what? When the transaction has taken place. So that is that one they are talking about.
Please.
Accrual basis. So revenue is earned in each month.
Base, no cash.
Okay. So
all right, thank you.
Revenue will be earned in each month, but we are receiving the money the following what month. So the following month doesn't mean that is the month that the sales was made. Okay. All right.
All right, thank you.
So let's now look at the difference, the A minus B. So we have 34, 6,800 minus what? The figure here. So the 34, 6,800 minus what? The total payment of 578812. I'm having a negative of 23,212. Okay, so we have opening balance here, opening cash balance if there is any, and question has given us that. So this is the net cash flow that we are having for the year, and we now add the balance that we have in the accounts. Okay, so what are they? He has 50,000, so that is the opening balance. Okay, so that will be 50,000. So our closing balance will now be plus 50,000. So I'm having 18,2012. That will be the closing cash balance. Okay, this will become opening balance for these people. So this will be negative 18,2012 as
Please, so the 2329.
So please, where did you get the net cash flow for January?
or is there a difference between receipt and then the payment? So this is the receipt.
There was no receipt in January.
Oh, sorry, Charlie. Sorry. So there's no receipt in January.
So that will be, yeah. So that will be loss of
So that will still
578812.
be 578812. Okay. So they have. So what will be the difference? 52. That will be 528812. Is that correct?
Yes, sir.
Okay. So that will still be 528812. So you can now add the rest and now move on in peace. Okay. What do I want to talk about? If you have a flexible budget, they can examine high or low method using the what. So they will give you more than an activity level. You can see that the question that we solved, okay, the flexible budget that we solved first, we are giving only an activity level here. So the activity level over here is only 5,400, which is the actual, and the budget is what? 6,000. Sometimes they can give you a budget with a different activity level. So which will be maybe they can give you 6,000, 8,000, 10,000. And you have to find your cost by applying the principle of the high or low method. Okay. So as I said that I will so that you have an idea about the high low, I will get that video and what so that you have a full idea. Although those who attended our class, we have done high low, but we have just used it for calculation of the variable cost and then also the fixed cost. But I don't have any question over here, so I cannot demonstrate that enough. Okay, so let's see what will happen. Let's now come to standard costing and variance analysis. Please, you have to pay attention to advanced variances. If I say advanced variances, I mean by how do we calculate variances for fixed overhead. You see, some of the variances can be divided. Mostly they are usage variances, the volume variances. Material usage variance is divided into material mix and material yield. Fixed overhead volume variance is divided into efficiency and capacity variance. The sales volume contribution variance is divided into sales mix variance or sales mix contribution variance and sales quantity. Okay. And sometimes they can also ask you to calculate the variances at the various level. The first one that we have done, they can ask you to calculate it at planning level and also at operational level, which I have a question on it over here. So we can easily demonstrate that if we are looking at the planning and the operational level. So you'll see how we go about the total variance that we calculate under the basic one, it can be separated into planning and also operational. Okay, we are going to be looking at that. They can also ask you sometimes, you calculate certain ratios, efficiency ratio, capacity ratio, and production ratio, and you also comment on that. Okay, so they can ask you that, and they can also ask you the basic variances, the one that you know, material price, material usage, labor rate, labor efficiency, or labor idle time variance, or variable overhead expenditure variance and variable overhead volume fixed. They can ask you those ones, and they can even ask you to reconcile your actual profit against your what? Your budgeted profit. You have to actually pay attention to those ones. But we have few questions over here which we'll be solving. But you also have to read about the types of variances that we have. The types of variances that we have. We have the ideal variance, which is set under a perfect working condition. It is set without taking into consideration allowances for what? For losses. You are a seamstress or you are a tailor. You are going to be sewing a dress for somebody. And instead of you to make allowance for, so you are going to do top and down. Top and down will take like maybe 4 years. You see, you are not perfect, you are human. In the cutting process, you might be making a mistake. So at least you have to buy like 5 years so that even if you made a mistake in the cutting process, you can use the one excess to cover that. But you are saying that you are going to be perfect and you are going to be using all the 4 years without any mistake. And this will not always not be the case. That is what we call the ideal what? Standard. Setting standard under the perfect working condition, thinking that everything is going to be perfect. There will not be any loss. This standard will always result in what? In a what? In a adverse what? Variances. We also have the attainable standard, or we can say the normal standard, which is set taking into consideration what? The losses. We take into consideration we are human, so we cannot be perfect. So it is likely that during the process, there might be a material mishandling. There might be some machine breakdown, which is going to be affecting our production. So we have to make provision for these ones. So there's a provision for normal loss. You are buying, you are going to use 4 years. You have to buy 6 years, make allowance for 1. So that if something happens, yes. But situation where we make an allowance and there's still a variance more than that, then that means that there's an abnormal loss. So we have to now investigate that. Okay. If you come to one that we have the basic standard, the standard is being set for a particular period of time. So we can set a particular standard for 5 years. We can set a particular standard for 5 years. That's what we call the basic standard. It's being set, and most sometimes they are not changed. It will be set for a number of periods. That is basic one. Then we come to the current standard. The current standard is always a standard that is being set for every year, or they are always set out of the basic standard. So what is what we want to do now? So you'll be taking the 5 years projection that you have. You'll be taking each year from it. Each year from it. That can be called the current standard. They can ask you to explain this also. You should be able to explain this. Advantages of variance analysis and disadvantages also. You also have to read on that. Okay. But let's look at the planning and operational variances first. Then we look at some issues about work back variances, where they will give you a question. You have to now find the items yourself. Okay, they will give you the items, you calculate the variance. They can also give you the variances and ask you to calculate the items. So we also look at that in the, maybe we can try to look at the efficiency and these ones I'm talking about over here. Okay, you can also, then we see whether we can look at material if we have time. We have 1 hour 30 minutes more. Let's try and see the number of what the questions that we can solve within this period. Okay, please, variance, we are comparing our standard with the actual performance. You are saying that you are going to be using 20 cedis. Okay, you are saying that you are going to be using 20 cedis whenever you want to purchase a material. Okay, you are going to the market. Okay, as you are going to the market, you are saying that every tomatoes that you are going to be buying, you are going to buy a piece of tomatoes for, or at a price of 20 cedis. Okay, now you went to the market and bought 200 pieces for what? for 5,000. Okay, this is the actual amount that you have spent. Based on our budget or based on our target, how much should I have spent on the 200? How much should I have spent on the 200? We are saying that we are going to be buying. That is our target from the house, that we are going to be paying 20 cedis for every tomatoes that we are buying. We ended up buying 200 and we paid a cost of what? 5,000. Based on our budget, based on our estimate, based on our target, how much should I have spent on the what? On the 200 tomatoes?
$40,000.
Would that be
25.
40,000 or 4,000? Will it be 4,000 or 40,000?
Sorry, 4,000.
Okay, that will be
4,000.
4,000. Okay, so we are saying that we are going to be buying a tomatoes for 20 cedis. We ended up buying 200. So based on our target, how much should I have spent? We should have used 20 to buy 200. So that will give us 4,000. But at the end of the day, we have what? Paid what? 5,000. What is happening there? We have overspent what? By 1,000. That is a price variance. That's a difference in what? In our spending. So we just compare our standard, which I can say the flexed budget. We have a fixed budget. That is the standard. Okay. Now, this particular standard is for a particular level. And at the end of the day, we have done this. So based on our budget, based on our standard, what should have been the amount or what should have been the result for that compared to the actual results? Okay, so you always flex your standard to reflect the actual performance. Then you now compare. You can't compare someone that is working for 2,000 hours with someone that is working for 1,500 hours. It's either you bring the 2,000 hours worker to what? 1,005 hours before you can compare. They are using two different words, issues. That is what we are going to be looking at under the variance. Okay, let's look at question number 3 and see how we can go about that. Sinaben, are you there? If Sinaben is not there, Auntie Bell, can you take that for us? Very simple. Let's move on.
Okay. The law company makes high quality. Sorry, let me start again. The law company makes high quality handmade chocolate truffles, which it sells to a local retailer. All chocolates are made in batches of 16 to fit the standard boxes supplied by the retailer. The standard cost of labor for each batch is 6 Ghana cedis, and the standard labor time for each batch is half an hour. In November, Trailer Company had budgeted production of 24,000 batches. Actual production was only 20,500 batches. 12,000 labor hours were used to complete the work, and there was no idle time. All workers were paid for their actual hours worked. The actual total labor cost for November was 136,800 Ghana cedis. The production manager at Trailer Company has no input into the budgeting process. At the end of October, the managing director decided to hold a meeting and offer staff the choice of either accepting a 5% pay cut or facing a certain number of redundancies. All staff subsequently agreed to accept the 5% pay cut with immediate effect. At the same time, the retailer requested that the truffles be made slightly softer. This change was implemented immediately and made the chocolates more difficult to shape. When recipe changes, when recipe changes such as these are made, it takes time before the workers become used to working with the new ingredient mix, making the process 20% slower for at least the first month of the new operation. The standard costing system is only updated once a year in June. No changes are ever made to the system outside of this. Required. Calculate the following variances for trailer company. Labor rate planning variance. labor rate operational variance, labor efficiency planning variance, and labor efficiency operational variance. A. A company you, or that is not part.
No, you can. You just move on.
Okay. A company uses a top-down approach to budgeting. Budgets are improved by senior management, and budget holders are not given the opportunity to participate in the budget setting process. Required. Explain one advantage and one disadvantage to the company of using this top-down budgeting approach. Thank
All
you.
right. Thank you.
Should I read the question too?
No. We have to take the first one before.
Okay.
Okay. So they are asking us to calculate the labor rate planning variance and also the labor rate operational variance. This is just like the normal calculation of the labor rate and also the labor. So let's come to question number 3, which is the LACO. Okay. Please, how do we calculate labor rate variance? Labor rate variance. It is calculated as comparing our flex amount for the labor against the actual amount. Okay. So we are saying that okay, if we don't want to pay, okay, if we don't want to pay, what is going to happen is that if we don't want to pay the maximum amount that we can pay per hour based on our targets or based on our standard or based on our budget, the maximum amount that we can pay per hour is what? Is 20 Ghana cedis per hour. Okay. The people have worked for 2,000 hours. Okay. The people have worked for 2,000 hours and you have paid them 45,000 Ghana cedis. Okay. Based on our target, how much should have been paid to the people? Based on the amount that we are saying that we are going to be paying per hour, how much should have been paid to these people?
40,000.
Okay, that will be 40,000. But what was the actual amount paid? The actual amount is for 2,000, but the amount that we're supposed to pay for 2,000. So we have paid how much in excess?
5,000.
Okay.
5,000.
How did we get that? You can see that this is calculated as 20 multiplied by 2,000. Okay, minus what?
45.
45,000. Okay. Okay. Someone can also say that, okay, if I'm paying 20, if based on standard, our budget, we are paying 20, then what is the actual rate paid to the workers now? Someone can do the actual rate for the workers by doing what we call the 45,000 divided by 20. I'm having 22.5. Okay, so if I'm saying I'm going to be paying 20, at the end of the day, I'm not paying 22.5. It means I'm paying 2 CD50 pesos in excess. So if I'm paying 2 CD50 pesos in excess, I'll be paying this in excess for 2,000, and that is going to give me 5,000. So someone can say I'm going to do 20 minus 22.5, which is the excess amount multiplied by the hours that this has been paid on. That's how you have the standard rate minus what? The actual rate multiplied by the actual hours paid for.
Hours paid.
Not actual hours worked. Okay, people can have an idle time. They will be paid for the idle time. So we are interested in how much was paid. We are interested in how much was paid. So actual hours paid for, not the actual hours worked. Okay, so the labor rate, from what I have demonstrated, labor rate can be calculated, labor rate variance can be calculated as the difference between the rate that we're supposed to be paying minus the rate that has been paid. So we have the standard rate minus the actual rate multiplied by the actual hours worked for. Okay, actual hours worked for.
Paid for.
Okay. Actual hours paid.
Yes, it's paid for.
Okay. Actual hours paid for. Okay. Please, though I don't encourage the formula, but to some extent you have to know it. Because if you know it, if you are doing the work back variances, where they will give you the variances and you have to find the standard quantity per unit and those ones, it will be very important for you. Okay. So it's the same labor rate that we are going to be calculating, but this will now be calculated in two levels. It will be calculated in two levels. One will be calculated at what we call the planning level, and one will be calculated at what we call the operational level. So the planning level is, okay, what was the budgeted labor hours? Was there any revision? So the budgeted up to the level that it has been revised. That's what we call the planning level. Before this particular estimate will be given to, or the revise will be given to the operational level. So I have done that first from the strategic level to the tactical level. That is what we call the planning. The difference over there is what we call the planning variance. From the tactical level to the operational level, the difference that's happening over there is what we call the operational variance. So we are budgeting for 20,000. Managers are saying that no, 20,000 is too much. So the best that we can produce based on resources is 18,000. There's a variance of 2,000. That's what we call a planning variance. That's at the planning level. Is before the plan will even get to work. So the managers will now have 18,000. This 18,000 will be expected by the employees or by the workers to achieve. So if at the end of the day, the workers are able to produce only 16,000, there's also 2,000 over there. That particular 2,000 is what we call the operational variance. So we are going to be doing this under the planning level and also the operational level. So it's the same formula, but just that the figures that we are going to be using will be different. Okay, but the actual hours worked will still be, the actual hours paid for will still be the same, because we are just calculating like a normal variance, but just that the figure that we are changing. So we still maintain the actual hours paid for. Okay, that is the, so let's come to the planning rate variance. Planning rate variance. So that will still be as the standard minus what? The standard rate. The standard rate will be the one that is being given, the budgeted one minus the revised rate. Let me just use the revised rate, RR. If I use the actual, someone might be thinking at the actual value for the year. No. At the planning level, the actual is the revised amount. Okay. So the revised multiplied by the actual hours what paid for. Okay. Let's come to our standard rates. Okay. Let's go to the top there and we look at what we call the standard rates. Okay. The standard cost of labor for each batch is what? Is 60 days. And the standard hour time for each batch is half an hour. Do we pay laborers per batch or we pay them per hours?
Per hours.
Okay, so we find the rate per hour, not the rate per the unit that they are producing. No, they will be paid based on the number of hours that they have worked. Okay, they are saying that these people are paying, we are paying them 60 days per batch, and they are taking half an hour to produce a batch. So how do we find the rate per hour now? Okay, we know that the cost per unit is calculated as what? The rate multiplied by the number of hours. Is that correct?
Yes.
Okay. But the cost per unit is now 6, isn't it?
Sure.
Do we know the rate? No. But we know the number of hours, 0.5. Is that correct? Okay.
Yes.
Can we have 6 is equal to 0.5 hour? We divide both 2 by 0.5, 0.5. That will give us R is equal to 12. Is that correct?
Oh, yes.
So if you want to find the cost per, we are using half an hour to produce a unit, and we are paying 12 cedis per hour. So our cost will be 1/2 multiplied by 12, and that's how we have the 6. So we use the rate per hour, not the rate per unit that we are producing. Labor will be paid in hours. So we measure their variances in what? In hours also. So our standard rate is 12. Okay, our standard rate is 12. Okay, so the standard rate, the rate that is given to the people is 12. Let's come to the revised rates. Were there any information about the rates be increased or reduced? At the end of October, the managing director decided to hold a meeting and offer staff the choice of either accepting a 5% pay cut or face a certain number of redundancies. All staff subsequently agreed to accept the 5% pay cut with immediate effects. So what will be the revised amount now? The revised amount per hour?
That will be 95% of the labor cost.
Okay, I'm getting 11.4. Okay, so the revised amount will now be 11.4. Okay, so what we do now is, okay, so this figure will still be calculated. This figure will still be calculated. The labor rate will still be calculated like how we calculate our normal labor rates, but just that the rate that we are going to be using will be different. What is the actual hours used for the period?
12,000.
Okay, so you just multiply by your 12,000. So you still use your 12,000. Okay, what will be the amount that we are getting there?
7,200.
Adverse or favorable?
Favorable.
Okay, so we have 0.6 multiplied by 12,000. So we have 7,000.
7,200.
Okay, favorable. Okay.
Hello, sir.
Yes, please.
Where do we get 11.4?
They have accepted to reduce their salary by 5%.
Oh.
So we are paying them 12. Reducing by 5% means that they are going to be having 95%. So 95% of the 12 is giving us 11.4. Okay. So
Thank you, sir.
that is a planning variance. So let's come to our planning efficiency. Okay. Planning efficiency will still be calculated like how we calculate the efficiency variance. Okay, it's just like the normal efficiency variance. So we have the efficiency variance. We have our standard hours minus the actual hours worked. Actual hours worked.
So please, can I see the first one, the calculation?
Okay, minus the actual hours worked multiplied by the standard rates. Okay, but what is going to happen now is that we are going to be using our standard hours. Okay, how do we calculate our standard hours? Our standard hours will be the hour that we are saying that we are going to be using multiplied by what? The actual production. Okay. What is the actual production?
20,500.
Actual production is what?
20,500.
2500.
Okay. So how many hours are we using?
We use 12 hours.
Now we use 0.5 hours. We are using 0.5 hours.
12,000 hours.
Okay. Now our standard hours.
Okay.
Okay. The standard hours will be the standard hour per batch, which is 0.5 multiplied by the actual quantity produced. Okay, which is
20,500.
Okay. What are we having?
250.
Then 250.
Okay, we're having 10 to 50. Okay, we now come to our revised. The actual hours work will not be the revised. This is planning level, so we go to the revised. So what is the revised one? Let's go to the revised one now. So the revised hours now. Okay, what will be the revised hours? Let's look at that. They have said something about the process taking 20% slower. Okay. This change was implemented immediately and made the chocolate more difficult to shape. When reciprocal changes such as these are made, it takes time before the workers become used to working with the new ingredient mix, making the process 20% slower for at least the first month of the new operation. So the current hours will now be increasing by what?
20%.
Okay. So if you are increasing by 20%, what are we going to be getting?
12,300.
Okay, that will be 12,000. No, just increase the 0.5. The standard, which is 0.5, will increase by the 20%.
Okay, by 1.2.
0.6.
Okay, I'm having 0.6. Okay, so we have 0.6 multiplied by the actual production of what? 2,500.
$12,300.
Okay, we're having 12,300 hours. So let's calculate our rates now. So our standard hour will be 10,250 minus 12,300 multiplied by standard rate of 12. Is that correct?
Yes.
Okay. The rate will still be the standard rate, which is the 12, but just that the hours that we'll be using will be different. It's only the hours and the what? The two things that we'll be using. Still, the actual hours worked for the planning will still be the same, but the rates that you'll be using are the only one that will be different. So what are we going to be having from that place?
24,600.
Okay, 24,600.
600.
Okay, adverse or favorable?
Adverse.
Okay, that will be adverse. Okay, let's come to operational level now. Okay, so the operational rate variance now. Operational.
The 0.6 for the revised hours. How did we arrive at that?
Yeah, someone should help our dear brother. 0.6. How did you get a 0.6?
0.5
the question is saying,
by
Yeah, the question is saying that what?
0.5 by it has been increased by 20%.
Okay.
So I'm going to calculate the 20% on the 0.5, then add to 8. So you are going to have 0.6.
Okay.
That one I'm going to use for the revised one.
Okay.
So when you multiply the 0.6 by the 20,500, I'm going to have 12,300. That's
Okay.
the revised.
Okay. All right. Thank you, Senior.
Right, thank you.
Okay. They are saying that a new change will now make the what? The process 20% slower than the normal. If you are making it slower, it means that you are going to be spending more hours in the new production process than the before. So it means that these hours will now be, if you are now producing at a rate of what? 20%, which is lower. It means that you are going to be using more hours than the first one. So the hours has increased by 20%. So you just increase by 20% and okay. And you get your this thing as what? As a revise. Okay. So let's come to operational rate variance. The operational rate variance, we are still calculating the labor rate variance like that, but just that we are going to be using different rates. So operational rates variance is still calculated as the standard rate. The standard rate now will be the revised rate because the managers will now give the what? The revised estimate to what? To the operational managers to now operate. So the difference now will be what the manager has given to what? To the operational manager. So we have the revised rate, that will now be the standard rate over here. And then we come to the actual rate that has been incurred by these people, multiplied by the actual hours paid for. Okay, what is our revised rate in the question? We have calculated the revised rate, 11 point what? 4. Okay.
4.
Okay. Let's count to the actual rate for the normal work done. The actual rate for the normal work done, would that be 136 divided by 12,000 hours?
11
Okay. Okay, let's come here. They say the actual production was only 20,500 badges. 12,000 labor hours were used to complete the work, and there was no idle time. All workers were paid for the actual hours. The actual total labor cost for November was what? 136,000. And this was paid for 12,000. So what would be the rate per hour there? I'm having 11.4. Would that be 11.4?
Yes.
Okay. So the actual hours will now still be 12,000. We'll still be using the same thing, but just that the rate, the 12,000 will still be 12,000, but the rate will be different. But you can see that the variance over here will be 0. Is that correct?
Yes.
Okay. So there is no variance here from the revised. Let's come to the operational efficiency. So operational efficiency, please, they haven't examined this one before, so you need to focus. Okay, so this will still be our standard rate will now be the revised rate minus the actual rates. Okay, multiplied by the standard rate, which will still be the 12. So our revised one is what? 12,300. Is that correct? Minus 12,000 multiplied by 12. Our revised rate is 12,000. Our revised hours is what? 12,300. And our actual is this one. So we are having 300 multiplied by 12. What are we having?
3,600 favorable.
Are you sure? Okay, it's favorable. 3,600 favorable. Okay. Let's come here. Check something. Okay. What will be the total efficiency variance? The total planning variance will be 7,200. The total efficiency variance will be what? Will be the planning variance and then this one. What will be the difference? 24,600 minus that. I'm having 21,000. Adverse.
3,600.
Okay. No. The operational efficiency is 3,600. Planning efficiency is also 24,600. They are all efficiency. So if they ask you for the total efficiency variance, you just put the two together. So one is negative, one is positive. Okay. So that will be 24,600 minus 3,600. I'm having 21,000. Is that correct?
Yes.
Okay. But our
But Sina, explain that one for me.
oh no, this is favorable, this is adverse. So this is negative, this is positive. So you just add. If you put the two together, they are all efficiency. It's the same efficiency variance that we have calculated, but we calculated it at different levels. They are all relating to the same process. So instead of us calculating it straightforward, we have calculated it at what? Different levels. That is what we mean by, so you just add the two. One is favorable, one is adverse. So the adverse is 24,600. If you now add the favorable of 3,600, it means that it will now be 21,000 adverse.
Okay.
All right. Come here. If you come to your rate, your labor rate variance is 7,200, isn't it? Okay. You can also confirm something like this. Okay. Confirm something like this. Assuming we are calculating the labor rate variance without doing labor rate variance, without doing planning and operation, we are going to be having 12 minus 11.4 multiplied by 12,000. Would that be the answer? Assuming we are just calculating the labor rate variance.
Yes.
Okay. So 12 minus 11.4 multiplied by 12,000. What are we having?
Yes. 7,200.
Okay. Which is the same as this?
7,200.
Okay.
Favorable, yes.
Which is the same as the favorable because this is 0. So 0 plus 7,000, that will be favorable. So it means that you have calculated this one in two levels. It's just a total one that you are calculating, but you are calculating it at different levels in the planning stage or in the standard setting process. You are calculating it at each level. The planning stage, there will be a difference between the top people and then the tactical people. Then the tactical people will now give the revised to what? To the operational people. So the revised and then the actual result, there can also be a variance there. Okay, if you are calculating efficiency variance without doing anything, this is how it will be calculated. We are going to be having 0.5 multiplied by 20,500. Is that correct? That will be the standard hours. Our standard hour is 0.5. We are producing 20,500. So if we are using 0.5 hours per batch, okay, and we have now produced 20,500 per batch based on our standard, how many hours should have been used? That will be 20, that will be 10,250. Okay, 10,250. So we have 10,250 minus 12,000, which is the actual hours worked multiplied by 12. What are you going to be getting? You'll be getting 21,000 what? But you can see that you have calculated the 21,000 in two levels, 3,600 against what? This one. So sometimes they can ask you to separate or to split the variances into planning and operational variances. There is not anything difficult. It will be the same figures that you'll be using. For the hours will still be actual. For the rates, for the efficiency will still be the standard rate, but just that the figures that you are going to be using will be different figures. If you are using rates, your rate will be the standard and the revised one if you are doing the planning rate variance. But the hours will still be the actual hours. Okay. If you are doing the operational rates, your hours paid for will still be the hours multiplied by your revised rate and then the actual rate under the actual result. That will still be the same thing. So we calculate it in different levels. That is it. There's nothing difficult about. There's nothing difficult about this. Okay. So let's count to, we have less than 1 hour. Let's see what we can do about the remaining ones so that we can.
Hello, sir.
Yes, yeah.
Please, so the operational rate variance, is that right?
Yes, please. All right. So let's take that theory question there. A company uses a top-down approach to budgeting. What do you mean by top-down approach? Top-down approach to budgeting.
Hello, Senior.
Yes, yeah.
It means it's budgeting done at the top level of management without the involvement of the operational level people or the employees.
Okay. Okay. Budgets are imposed by senior management and budget holders are not given the opportunity to participate in the budget setting process. What would be the opposite of this? Okay, that would be participating, or that would be there's another name for it.
Bottom up. Down. Bottom up. Yeah.
Okay, that would be bottom up was budgeting. Okay, they say states explain one advantage and one disadvantage to the company of using this top-down budgeting approach. What is the advantage? Everything has advantage and disadvantage. What is the first thing that you think that will be the advantage? What about time?
It uses less time.
Okay, so it's not time consuming. That is the first thing, because we don't have to seek the opinion of somebody that everybody will say this, everybody will say that, and at the end of the day, we will not even find or we not even conclude on issues. We just sit there and do everything. This will also be what less expensive. You don't have to come and buy item 13 for anybody to come and what. No, we don't have to, because if you want to invite maybe at least 30% of the employee, we might be incurring certain costs, or we have to now get a space that we can contain these people, and there's an amount of money will be going there. So it's not time consuming, it is less expensive, and also what again? I have said two. So if we should add I've said the easy ones. Okay, I'm trying to get some of them for you, and it's okay. Let's hold to they say one. Let's hold on to the two now. What are some of the disadvantages?
It's demoralize the employees and stuff.
Okay, that is okay.
It may reduce the motivation levels of the lower level managers.
Okay, that is what you mean by the okay. So you either use motivation or you use what he is talking about. Okay.
Unrealistic targets may be set.
Okay, unrealistic targets may be set. That is fine. And this is likely not to achieve the what? Not to achieve yeah. This is likely not to achieve the what? The intended target, because if you are not involved, you see that if we are involved, okay, if you are involved, you know that okay, these things have been agreed on by us. So we can't let this particular agreement we can't let it down. We have to do everything. We have to put in our best to ensure that okay, what we have suggested is okay. Okay, so those are the issues there. Let's see whether we can tackle the question number 4 and the question number 5 before the place. Tomorrow we try to look at the short-term decision making, and I'll get a time for it so that we look at the long-term decision making. Even if we can't get time, I'll solve those questions. I can do the Zoom myself. I'll get some time, solve it, or just solve it in a paper or on a paper, so that I'll just share with you and you look at it. If you have any problem, you can always, although you send the work, it will be there for some time, but I will surely check it for you. Okay, let's come to question number 4. This is the work back variances. So the work back variance approach. Okay, they have examined this one once, that is March 2023. They have not examined the planning and operational variances. It has examined only as a theory part. Okay, so they can examine advanced variance, which the planning and operational is part of it, or they can limit it on material, where they will be asking to calculate the material price variance, the material mix, and also the material yield and the material usage. Okay, or they can just give you the normal variance, the basic ones, calculate your material price, those ones, or they can ask you to reconcile a statement. Okay, so let's look at that. Let's take the question number 4 and see if we can have some time to brush through. Or this one, they can also give you this one, which is one of the easiest, which is just a formula 10. Okay, it's just a formula 10. That's question number 5. So let's see whether we can finish the 3. Okay, the first 2 and see. We have 15 minutes more. Question number 4, Auntie Bell.
Question 4. The following profit reconciliation statement summarizes the performance of one of Dell's products for March 2021. We have budgeted profit, sales volume variance, standard profit on actual sales, and then selling price variance. Our cost variances, adverse and favorable. Direct material, favorable. Direct material usage, adverse. Direct labor rates, adverse. Direct labor efficiency, adverse. And then variable overhead expenditure, adverse. Variable efficiency, adverse.
You don't worry. Go to
Fixed
the data.
additional information.
Okay.
Okay. the budget is that place. Should I read that side or I should
Yeah,
go
the
to
budget
additional?
for the same period.
Okay. The budgets for the same period contained the following data: sales volume 1,500 units, sales revenue 20,000 Ghana cedis, production volume 1,500 units, direct materials purchased 750 kg, direct material used 750 kg, direct material cost 4,500, direct labor hours 1,125, direct labor cost 4,500 cedis, variable overhead cost 2,250, fixed overhead cost 4,500. Additional information: 1. Stocks of raw materials and finished goods are valued at standard cost. 2. During the month, the actual number of units produced were 1,550. 3. The actual sales revenue was 12,000 Ghana cedis. 4. The direct material purchased were 1,000 kilogram. Required: calculate the following: the actual sales volume, the actual quantity of materials used, the actual direct material cost, the actual direct labor hours, the actual direct labor cost, the actual variable overhead cost, the actual fixed overhead cost. Thank you. Please, I'm done.
Okay, thank you. Okay. Okay, so what are they asking us to calculate? The first one is actual sales volume, isn't it? Is that the case?
Yes.
Okay, actual sales volume means what? Actual sales quantity, is it, or actual quantity sold, isn't it?
Yes.
Okay, so we will not come here. You see, for the sales, we have only two variances under the sales. Okay, for sales, we have only two variances. Okay, so the first variance is the sales price or selling price variance or the sales price variance. Okay, the sales price variance. And the sales price variance, what we do is we have the sales price variance. We look at our budgeted or our standard selling price. So the sales price variance, we have our standard selling price minus the actual selling price multiplied by the actual quantity sold. What we are doing is that, okay, how much are we selling? How much are we saying that we are going to be selling 1 unit? Okay, and what was the actual quantity sold? Based on our selling price, how much should have been derived from this particular sale and how much has actually been derived? We compare the two and know the difference. Another one is we calculate our sales profit or contribution variance. It depends on what the question is using. So if the question is using marginal costing, this one, the variance will tell you that the company is using absorption costing. Because if you're using absorption costing, we calculate fixed overhead expenditure variance and also fixed overhead volume variance. But if it is marginal costing, we only calculate the fixed overhead expenditure variance. Okay, so this will tell you that this is absorption costing. Okay, so you just have to ask yourself, how do we calculate these figures? Okay, the sales volume, the actual sales volume. Sales volume, I have only two sales volume variance, the basic variances. Okay, each of these variances, which of them or have I been using what? The actual quantity to calculate. So you write the two. So we have the sales volume profit variance that will give us the budgeted quantity minus the actual quantity multiplied by the budgeted contribution, budgeted profit per unit. So budgeted profit per unit. Okay. So you now ask yourself, based on these two now, which of them will I have enough information for me to calculate my actual quantity? So go to the information given to you. the budget for the same period contain the following data. So how many units are we selling?
1,500.
Okay, we are selling 1,500. Okay. For how much?
20,000.
Okay, so what will be the selling price per unit?
$13.3.
Okay, don't approximate. Okay.
Yeah,
Don't
13 point.
Okay, don't approximate. Just make it the the best figure that you can make it. Okay. Just make it the best figure that you can make it. So that would be 20 divided by, would that be 20 divided by 1.5?
Yes.
20 divided by 1.5, isn't it?
Yes.
If you approximate, you might not be getting the actual figure. So let's see whether we can find our standard selling price. Our standard selling price is the budgeted sales or the budgeted revenue. Budgeted revenue divided by our budgeted volume. Okay. Our budgeted volume. So we are going to be having 20 divided by 1.5. Okay. Can we be able to get information on the actual selling price? Can we get information on actual selling price? We can get information on actual selling price, isn't it? Okay. If you cannot get information on actual
Yes.
selling price, you have to expand. Well, let's expand this formula. Can we say that the formula over there is XPV, okay, is equal to the selling price multiplied by the actual quantity minus the actual price multiplied by actual quantity? Can we say that is the figure? That is the issue there.
Exactly.
Okay. Please, if you look at this, you have the budgeted quantity, you don't have the actual quantity, and you don't have the budgeted contribution to, you can't calculate the budgeted contribution from this side. It will be very difficult for you to calculate budgeted contribution using this figure. So just ignore the sales volume, profit variance, and focus on the one that is going to give you all the information that you need. Okay. Can we say that this is the same as 20 over 1.5 multiplied by the actual quantity minus, okay, we know that the actual selling price minus the actual quantity will give us the actual sales volume. Is that correct? Give us the actual sales revenue.
Yes.
Okay, if you multiply the actual quantity by the actual selling price, it is the actual revenue that you are receiving, and the actual revenue given to us over here is what?
It's 12,000.
Okay, so we can factor in the 12,000 as a figure here. Okay, what is our sales price variance? We have been given that figure. Sales price variance is what? Let's go there. Sales price variance. Sales price variance is what?
4,000 adverse.
Okay, 4,000 adverse. This is where we have to determine whether it is going to be negative or positive. If it is adverse, okay, if it is adverse, it means that we are subtracting the actual from the budgeted, isn't it? How do we determine the adverse? It will be the budgeted quantity being lower than what? The actual quantity being lower than the budgeted quantity. So we have adverse. Okay, so if revenue relating to sales is what is adverse, it is always positive. So how much are we having there? If it is okay, how much are we having there? 4,000. Okay, so we have 4,000. Okay, so let's now work to expand. Can we say that this is the same as 1.5 multiplied by 4,000 is equal to 20 A cubed minus 12,000 multiplied by 1.5? Is that correct? The SCM over here is 1.5. Okay. 1.5 multiplied by 4,000. What are we having?
6,000.
6,000. Okay. So we have 6,000 is equal to 20 AQ minus what? 12,000 multiplied by 1.5.
18,000.
Okay. That will be negative 18,000. Okay. So can we have 6,000 plus 18,000 is equal to 20 AQ? Okay. So this will be 24,000 is equal to 20 what? AQ. Okay. So 20 AQ. So we have 20. We have 20. Our actual quantity will give us what?
1,200.
Okay. So that is 1,200 units. So this will actually give you adverse. This is revenue. So if you are selling lower than what the budgeted, that will be going against you. So this is our actual quantity for the actual sales volume. That is the actual sales volume. Okay. Let's come to actual quantity of material used. Actual quantity of material used. Okay. Actual quantity of material used. Actual quantity of material used can be calculated. We can use actual quantity of material used to determine the actual quantity of material used. So the B, we can use the actual under our two different situations. We can use it under material price variance, which we are going to be having the standard price minus the actual price multiplied by the actual quantity purchased or actual quantity purchased. Okay, let's come here. We can also have this one. We can also have the material usage variance, where we are going to be having the standard quantity minus the actual quantity multiplied by the standard rates. Okay, then we now ask ourselves, we are going to be finding only one item. So it means that we need what? We need at least 3 of these items to be able to work. So we go and look at the question and say, based on these formulas, which of them that we can get at least 3?
Is it standard price or standard rate?
Now this is material. So we use price for material and rate for labor.
Hello, sir.
Yes, please.
The first one, are we calculating sales volume or sales in quantity?
Material and sales, they all use price. It's only labor that uses rates. So we are calculating material price variance.
I mean, the first one.
This one?
The one we just calculated and we have 1,200 units.
We are calculating for actual quantity sold, actual sales volume.
Oh, okay.
No. Okay. So let's come to the question and see if we can get enough information to do that. Okay. We need the material price variance. We are given the material price variance. That is right, isn't it? Okay, we are giving material price variance. That is favorable. We are giving the material usage, isn't it? Okay, so let's determine. Let me write them first. So material price variance was given to us. Okay, that was given. Material usage variance was given. So let's see which of them that we can get at least 3 information on them and move on. Okay, so if we want to use the material price variance, we need a standard what? We need a standard. We need a standard.
The standard price and the
actual price, so that we can get the actual quantity purchased or used. Okay, if we want to use a material usage variance, we need a standard quantity. We need the actual, we are calculating the actual quantity, so we need a standard rate. So we need this, we need this, we need this. Okay, let's see which of these ones that we can get information on to be able to do this. Okay, let's come to the additional information. Okay. Our production volume is what?
1,500.
Okay. The direct material purchased based on budget.
750.
Okay.
8 kilograms.
Direct material used.
750 kilograms.
750.
Okay. Direct material cost.
4,500.
Okay. Direct material cost. So from this place, let's come here. Can we calculate the material usage per unit? Can we calculate the standard material usage per unit? Can we calculate? We are producing 1,500 and we are using 750 kilogram. What would be the kilogram per unit?
0.5. 0.5.
So that would be 0.5, isn't it? So as soon as we know 0.5, can we calculate our standard quantity for the period? Standard quantity will be standard quantity will be 0.5 multiplied by the quantity produced during the year, the actual quantity produced during the year. That will be 155. What are we getting?
775.
Okay, so we have 775. That is our standard quantity. So we have the standard quantity also now. So we can come here. We have the standard quantity here. So we have standard quantity now. Standard quantity will be equal to 750 over 1,100 multiplied by the actual production. That will be 775 kilogram. Okay. Can we have the standard price for the material? Can we calculate standard price for material? How much is the direct material cost?
4,500.
Okay, how many kilograms are we using?
750.
So what will be the cost per kilogram?
6 cities.
Okay, so we can calculate our standard price over here to be 4,500 divided by 750. That will give us 6. Okay, so you can know that we know the standard price over here. We know this one. But can we calculate actual price in the question given to us?
Yes.
Can we calculate the actual material price in the question given to us?
Material purchase.
You are not giving.
Yes, we should be able to.
You cannot calculate. You are not giving. Are you giving the cost, the actual cost of material in this question?
But since we know it means that we cannot use the standard multiplied by the actual purchase.
No, if you are doing that, you are looking for the standard.
The flex budget.
Yes, please. So you cannot calculate actual rate over here. It means that the first formula cannot be used. Okay, we can only have, we can have this, we cannot have this. And we are looking for this, so we cannot be looking for 2. So we now ignore this. But let's come here. We know our standard quantity already, isn't it? And we know our standard price. And we also know our material usage variance. So we can go ahead with this one. So let's come to our material usage variance is equal to the standard quantity minus the actual quantity multiplied by the standard price. So let's go to the question to have our material usage variance. Material usage variance is what?
150 adverse.
Okay. If it is adverse, it means that the actual quantity is higher than what?
The standard.
Okay, so this will be negative 150. So this will be lower than this one, so you'll be having negative. What is our standard quantity? 775, isn't it?
Yeah.
Okay, do we know our actual quantity? No. Multiply by the standard price of 6, is that correct?
Yes.
Okay, can we have negative 150 is equal to 775 multiplied by 6? 6 multiplied by 8. Okay, so we have negative 150 is equal to 77 multiplied
4650.
46.
46.
50.
So we have 4650 minus 6 AQ. Okay. So we have negative 150 minus 4650 is equal to negative 6 AQ. So what are we having?
482 divided by 6, 800.
So negative 6 AQ. This will also be negative. Divided by negative 6. Divided by negative 6. Our
800.
okay. Our actual quantity will now be 800 kilogram. You can see that this will actually give you adverse, isn't it? Because adverse means that actual quantity must be higher than what?
The standard.
Okay. So the question did not ask you to find the actual quantity per unit. So sometimes they can ask you the actual quantity per unit. How do we calculate the actual quantity per unit? It will be the 800 divided by the actual production level. So 800 divided by 1550. That will give you 0.15. But they are not asking you that. They say actual quantity of material what used. We are done with that. Okay. Let's count actual direct labor cost, actual direct material cost rather. So we have the C to be actual direct material cost. Okay. We know that actual direct material cost, we can only calculate it using the material price variance, isn't it? Okay. Because material usage variance, there is no cost item there.
Pricing.
Okay. So we have the standard price minus the actual what? Price multiplied by the actual quantity purchased, not used. Okay. So what is our material price variance? Material price variance is what is the figure there? It's 1,000 favorable, isn't it?
Yes.
So if it is 1,000 favorable, it means that this figure will be higher than this figure, isn't it?
Yes.
So the resultant will be positive. So you make the favorable to be positive. Okay, what is our standard? That is 6, isn't it? Our standard price is 6 minus the actual price. We don't know. But the actual quantity purchase is what?
1,000.
Okay. The question says that we use a standard cost. Stock of material and finished goods are valued as standard cost. Standard cost means that we use the actual quantity purchased. But if they are saying that the company use actual cost, then you have to now look for the what? The cost on the actual quantity used. So if you're using a standard cost, it means that there might be closing stock of material. We are not concerned with that. We are concerned with what is the total amount purchased or what is the total amount paid on the material being purchased. That's what we mean by the standard cost. We are buying 1,000, but we have used only 800. If the question is saying that we use actual cost, then you multiply your answer by 800 because we just want to know the cost incurred on the 800. Okay. But if they say standard cost, it means that you are looking for the total amount spent on the material, whether you are able to use all or you are able to use part. So our material price will be valued at the actual quantity purchased. We purchased 1,000 and paid what? For the 1,000. So what is the total amount paid for the 1,000? That is the standard cost that they are talking about. So we multiply this by the 1,000 now. Okay, so we have 1,000. This will be 6,000 minus what? 1,000 AP. Is that correct? Okay, so we have 1,000 minus 6,000 is equal to 1,000 AP. So we have negative. This will be
5,000.
Okay, negative
Okay, minus
5,000. Okay, so negative 1,000. Negative 1,000. What are we having?
1,000 positive.
Okay, so that will be five
Sorry.
Ghana cedis. Okay,
5
but
Ghana cedis.
they are asking for what? They are not asking for the price per unit or per kilogram. They are asking for the actual direct material cost. So the total cost will be what? That multiplied by the actual quantity. So the actual direct material cost is 5,000. So they are not asking for the price per kilogram. They are asking for what? For the total cost. So that will give us 5,000. Okay. So that will give us 5,000. Okay. So let's see. This, I'm sure this is the last question that we can solve. Let's come to actual direct labor hours. Actual direct labor hours. Okay. So we also go and quote the formula for the labor hours now. Okay. We have two. We have the labor rate variance, which is equal to the standard rate minus the actual rate multiplied by the actual hours paid for. Then we have the labor efficiency variance, which will be the standard hours minus the actual hours worked. Actual hours worked. Actual hours worked multiplied by the standard rate. Okay. So let's go
Hello,
to the question. Yes, yeah.
yes, but is there a situation where the actual hours paid will be different from actual hours worked?
Yes, please.
So it means in the question, they can give you actual hours paid and actual hours worked.
Exactly. And there'll always be an idle time. It means that the people have not worked, but you have paid them for that. So you have to calculate the idle time variance for those people. And idle time variance is calculated as your actual hours paid for minus the actual hours worked multiplied by the standard rate. Okay. Okay. So it means that the people they have not worked for that particular hours, but you have paid them. So you have paid them for an idle time. So you always have to look for that. Okay, looking at this question, I'm not sure we can use the first one because we cannot calculate the actual direct labor hours over here. Okay, or the actual rate over here. So let's just stick to the efficiency variance. So what is efficiency variance for the labor? The labor efficiency variance given to us is what? Would that be 150 adverse?
Yes.
Okay. If it is adverse, it means that what? The actual hours worked is higher than the standard hours, isn't it? So this will be higher than this. It means that the resultant figure will be negative. So the resultant figure will be negative. This will be higher than this. So if you apply this from this, the resultant figure will be negative. Can we find our standard hours? I'm sure yes, we can do that. Okay. Our standard hours will be the actual hours per unit multiplied by the actual units produced. Can we find the standard hours now? Okay. The standard hours is what? What will be the standard hours per unit? We are producing 1,500 and we are using 1,000.
0.75.
That will be 0.75. Okay. So it will be the hours divided by the number of units that we are producing. So our standard hours will now be equal to 1125 divided by 1,500 multiplied by 1150. Is that correct? Our actual production is 15. Okay. So our standard hours will now be equal to the standard hours per unit divided by 1,500 multiplied by the actual units produced. That is the standard hours. Okay, that will give us how much?
1162.5.
Okay, so we have 1162.5. So minus the actual hours worked. We don't know that. So actual hours worked multiplied by the standard rate. Can we calculate the standard rate? Very simple. We can calculate that because we know the labor cost, budgeted labor cost, and we also know the number of hours that will be 4,500 divided by 1125. So that will be 4 cedis per hour. Okay. So 4 cedis per hour. So we have 4 cities per hour, and that will give us a standard rate of 4,500 divided by 1125. That will be 4 cities per hour. Okay. So we can now have this multiplied by 4. Is that correct?
Yes.
Okay. Can we have negative 150 is equal to 1162.5 multiplied by 4 into brackets 4 multiplied by, let's just say this is actual hours. Okay. So can we have negative 150 is equal to 1162 multiplied by
4650.
Okay. So we have 4650 minus 4 AH. So can we have negative 150 minus 4650 is equal to negative 48. Okay, what are we having?
I've repeated the process. Okay, it's 4,800 over 4.
Okay, so that will be 4,000 negative 1,000 divided by negative
4,200.
that will give us 1,200, isn't it?
Yes, please.
Okay, actual hours will be 1,200 hours. Okay, 1,200 hours. So we can now calculate the standard hours now. I can show that workings now. 11,250 divided by 1,500 multiplied by 1,550, which is equal to 1162.5. Okay, our standard rate will now be equal to 4,500 divided by 1125. That will give us 4. Okay, what is the next item that you have to calculate? The actual direct labor cost. Okay, the actual direct labor cost will be calculated using the what? The labor rate variance. Okay, labor rate variance. So that will give us the standard rate minus the actual rate multiplied by the actual hours paid for. Okay, since we don't have any information on that, we assume that the actual hours paid for is the same as the actual hours worked. Okay, so we have the labor rate variance. What is the labor rate variance given to us? Labor rate variance given to us.
200 adverse.
That will be 200 adverse. So 200 adverse means that the actual is higher than the standard, so the resultant will be negative. Okay, so what is the standard rate? 4, isn't it? That will be 4. So 4 minus the actual rate, we don't know, multiplied by 1,200. Are we okay?
Yes.
Okay. Can we say that this will be negative 200 is equal to 4 multiplied by 1,200 minus AR multiplied by 1,200? Okay. Can we say that this is negative 200 is equal to 4,800? Okay. Minus, can we say this, all of this will be the actual cost? Can we say that the actual rate multiplied by the actual labor hours worked, it is the actual labor cost? Is that correct?
Yes.
Okay.
Yes.
So if that is correct, our actual labor cost will be equal to 200 plus 4,800. Is that correct?
Yes.
Okay. So 200 plus 4,800. And that will give us actual labor cost of 5,000 Ghana cedis. Okay. If you like, you can find the rate per hour. But at the end of the day, you are coming to multiply by the 1,200 again. So just ignore. If they're asking you to find a rate per hour, then that is why you do it and find the rate per hour. But this one, they're asking for the total. So just ignore and bring the total as that. Let's come to the next one. Okay. Let's come to the next one. We have the actual variable overhead cost. Which of the variable overhead variance formula can we use to find this? If it is about cost, please, if it is about cost, it will always be about the rate variance. So let's come to the E here. This will be the variable overhead expenditure variance, which is calculated as the standard rate minus the actual rate multiplied by the actual labor hours worked. Variable overhead varies in relation to labor, unless the question is saying different thing. Okay, as soon as you are giving a variable overhead, it is assumed to be varying with the level of what? Labor activity, unless they are telling you a different thing. So they will not tell you variable overhead varies with what? Labor. Okay, so let's come to their standard rate. Can we calculate their standard rate in the question? Yes, we can do that. Okay, their standard rate, let's come to their standard rate there. What is the standard rate? Variable overhead cost. What will be their standard rate? This will be based on labor hours.
Standard rate is 2.
That will be 2. Okay.
It's
that will
2.
be 2250. These are budgets. As soon as you find a cost per unit, that will now give you a standard. So those total figures given to you over there are budgets. But as soon as you find a figure per unit, then it is now a standard. So our standard rate will be equal to the 2250 divided by labor hours. Variable overhead varies in the level of labor hours. Okay, so this one we don't have to suffer. We have the variable overhead efficiency variance. What are we having there? Variable overhead efficiency variances. I say efficiency, expenditure variance is what?
600 adverse.
600 adverse.
Okay, it means that the actual is higher than the standard, isn't it?
Yes.
Okay, so that would be, if you subtract to be a negative, the resultant will be negative. Standard rate is 2 minus what? Actual rate multiplied by the actual labor hours worked, which is 1,200. We have calculated that. So that will be multiplied by the actual hours worked. Okay, not paid for. Because for variable overhead, it can be supervisor's fee, and we are saying that it is based on the labor hours. So you only be paid for the hours that the people have worked. The time that the people are not there, you will also not be there, so you don't get any money. So the variable overhead efficiency, variable overhead expenditure variance is always calculated on the actual hours worked. Because if the people are not working, you will not get anything. Okay, so let's come here. I'm having negative
3,000.
Okay, negative 6,600 is equal to, okay, can we have 2 multiplied by 1,200? Okay, minus, we know that this multiplied by this will give us the actual cost. So we can have the actual cost here. So I have negative 600 is equal to 2,400 minus the actual cost. You don't have to find the cost per rate again. You don't have to find the actual cost per the labor hour, no. Or the actual rate. You don't have to do that. Because if you do that, you still come and multiply by the actual hours worked. So just leave it. We have negative 600 is equal to minus what? Minus 2,400 is equal to negative this one. So our actual cost, actual variable cost is equal to 3,000 Ghana cedis. Is that correct?
Yes.
Okay, let's come to the last one. Sorry, I'm tired.
It's not easy.
Actual fixed overhead expenditure. This is straightforward. How do we calculate actual fixed overhead expenditure?
Actual minus the
Budgeted fixed overhead
budget.
minus actual.
Okay, so that is it. That is very simple. You don't have to do anything. So the fixed overhead expenditure variance is calculated as a budgeted fixed overhead minus the actual what?
Fixed overhead.
Okay. So what is the variance given to us? What is the variance given to us? It's favorable, isn't it?
Yes.
Okay, 2,500 favorable. It means that the budgeted is higher than the what? the actual, isn't it? So the resultant to be positive. So let's go to our budgeted figure there. What is our budgeted figure? Budgeted fixed overhead is what?
4,500.
Okay. So we have 4,500 there. So we have 4,500. Okay, minus the actual. We don't know the actual. So we have minus the actual. So minus the actual fixed overhead. So we have 2,500 minus 4,500 is equal to negative actual fixed overhead. So this will give us actual fixed overhead expenditure. Will give us 4,500 minus 2,500. That will give us 2,000. Is that correct?
Yes.
Okay. Okay. So it's a very interesting, but I cannot give you, okay, anything is possible. Okay. Anything is possible. You just have to, that is not, this is the easiest one. Okay. If your mathematics is good, you just have to identify how you calculate. This is where the formula, memorizing the formula is very good. Okay. So you just have to ask yourself, this will always be given to you in relation to the basic variances. If you are giving in relation to the advanced variances also, you have to know how to calculate those ones. So ask yourself, if they are asking me for actual quantity or actual material quantity, the question is which of the formulas that I can find or actual quantity is used to calculate which variances. Then you write them down. The formula that you can find actual quantity there. Then you ask yourself, based on this formula, I need to know at least 3 things so that I can be able to find the fourth one. So which of the formula that I can find a ready information on them and use it to calculate for my item. One of them will not be giving you all the items, but one of them will surely give you the items that you're using. One of them will surely give you 3 of the items so that you can go ahead and calculate the fourth one. There is no big deal and there's no cause for alarm. Please try this question. Okay, it's very simple. So try this one. This one, we have even solved this one, okay, in class. So you can revise that again. Maybe they can bring a question on a material. They can bring a question on material, which will be material price, material mix, material yield, and material usage. So you have to go, or you can also do the basic variances again and do the reconciliation statements. It's just that we don't have time to solve all those things, but at least we have been able to revise some of the things and at least we can do something. Please, any question or any issue, we address that and call it a night. All right, so in the court of law,
Thank you.
in the court of law,
Hello, Boss Linus.
my name is Linus. Yeah.
Oh, senior. Okay, so please, what time are we meeting at dawn?
Hey, Africa. Okay, 3:30.
Oh, I've gone to check. I've not seen the message.
Oh no, it's on the timetable. 3:30 to, okay, 3:30 to maybe tomorrow is Saturday, so
To 6:30.
yeah, no, 3:30.
3:30.
That is on the timetable, but anything can happen. So maybe I would like to do the investment appraisal in addition to the short term. Maybe at least one question on investment appraisal. So maybe because I have FR at 10 a.m. So maybe around 7 or 7:30, maybe we can close. So don't worry, maybe I'm very fine. All right.
Okay.
Okay.
Thank you.
All right. All right. So
Hello, sir.
yes, yeah.
So it means you want to finish everything tomorrow.
Yes, please. No, we're supposed to finish the rest tomorrow. Okay. Suppose we had class yesterday. Okay. As we had class yesterday, we should have done the budget and the standard costing. Then today we just do the investment appraiser. Then tomorrow we do the short term. But now we have investment appraiser and short term. Okay. So the investment appraiser are only two questions. I can solve one and explain the other one. But for the short term, it can happen that they can bring a question on make or buy. So we need to solve a question on make or buy. This one, relevant costing. So we need to solve a question on relevant costing. They can also bring a question on which one? Maybe I'm not sure. Break-even analysis and those things. Make or buy was last sitting. So at least we should solve a question on pricing. Sometimes they can give you a question on the company want to set a price. So pricing strategies. So we need to solve one question, at least three, so that we know that, okay, we are done with that. For the investment appraisal, we can only solve one question because there are only two questions there. I'll just explain the remaining ones. Payback period, accounting rate of return, internal rate of return, how you go about them. That is all. All right. So,
Hello, sir.
yes, please.
Sir, please, with the variances, what we saw, what you just saw right now, the first, which is the actual sales volume, I want you to check that one for me.
Okay.
What we did was the sales price volume, sales price variance.
Yes, please.
So they said actual sales volume.
Yeah, is the actual sales actual quantity sold.
Yeah, and then with the sales, we have two types of this. We have the sales price variance and then sales volume variance too.
Yeah, and one of them cannot help you to solve. The first one, the volume cannot help you because you can't find your budgeted profit.
Please, the budgeted profit is there.
What is it?
That is budgeted profit 4250. First one.
Then you can use that one also. They have to give you the same answer. Okay. So the budgeted profit will be 420 divided by 420 divided by, I didn't see that one, 420 divided by the quantity that you are selling. That will be the budgeted. So divided by 1,500. That will give you, don't approximate. So just let's keep how we can keep it. Those who are using calculator, what will be the fraction given to you?
$2.8333.
No, don't give me decimals. It will not give you the same figure. Just give me the fraction that the calculator is giving to you. Don't do it too.
$70 over 6.
Okay, 17 over 6. That's what I want. So sales volume, profit. So
No, baby, I get
that will be budgeted quantity
and now
minus
therefore I'll keep
actual
Anna
quantity
baby, mommy, you are not
multiplied by 17.
Why?
17 over what?
Over 6.
Okay, 17 over 6. Okay, let's come here. What is our sales volume profit? What is our variance for that? Sales volume variance is what? 850. Is that correct? Okay. That is 850
Yes, sir.
850 adverse. It means that the what? If it is adverse, it means that the budgeted is higher than the what? The actual. So that the resultant will be positive. Because if it is adverse, we are selling less than what we are budgeting. So that will be 850. The resultant will be positive. Okay. So we come here, our budgeted quantity is 1,500, isn't it? Minus the actual quantity multiplied by 17 over 17 over 6. Okay. Can we say that this is the same as 850 is equal to 17 over 6 multiplied by 1,500 minus 17 over 6 multiplied by this one. So we can say 6 multiplied by 850 is equal to 17 multiplied by 1,500 minus 17 multiplied by 8q, AQ. So 6 times 6 multiplied by 650, what are we having? 850 rather. So I'm having 5,100.
5,100.
Okay, 17 times 1,500. I'm having 25.
25,500.
Okay, 17 minus 17, 8Q. Okay, so this will be 5,100 minus 25, 500 is equal to negative 17, 8Q. Okay, so what are we having as a difference there? 1,500. I'm having
2,400.
Okay, negative 2,400, 17 AQ. So negative 17, negative 17. AQ is equal to what?
1,200.
So they have to give you the same. I didn't see that one. You have to be getting the same figure. Okay. So you can use that one too. I don't have a problem with that.
Please, why did we get the 17/6?
It is a budgeted profit per unit. The budgeted profit in the question there is how much? Budgeted profit is 4,250 divided by the budgeted volume, sales volume, which is 1,500. So you'll be getting 2.33. Don't approximate, use fraction so that you can get the exact figure that will be given in the exam. But you can use the first one. I didn't see that one, so you have to be getting the same answer at the end. So any of them, you are good to go. All right. All right. So thank you for coming. I'll see you guys at dawn. All right.
Please, what time? 3:30.